Okay, good morning, everyone. Welcome to day 11 of our strategic virtual financial reporting workshop for accounting and finance professionals. Last week, we delved into extensive discussions on business combinations, and we also transit to understanding accounting for a group, where a group consists of the parent and the subsidiaries. And based on our discussions, we are able to introduce ourselves to the basic mechanics for consolidation. The first principle being principle of cancellation. And further to that principle, we're able to resolve to saying how this could have resulted in a goodwill and a gain on bargain purchase, and how a goodwill is treated at acquisition vis-a-vis gain on bargain purchase, and the subsequent effect of goodwill with respect to subjecting it to impairment test in line with the requirement of IAS 36. And we more or less look at the requirement of IFRS 10 with respect to accounting for such an impairment loss that might have arisen from such a goodwill. Furthermore, we looked at some basic tenets of accounting for investment in a subsidiary as at the point that investment was made by the parent in his own separate financial statements, which you have to look at from the perspective of the requirement of IAS 27. And also we extended it to when you chose to recognize it at fair value in line with IFRS 9. And also to understand what are the forms of considerations that are available, starting from the cash consideration up to share consideration, which is otherwise known as share exchanges, asset transfers, debt consideration, and additional considerations which could give rise to contingent consideration recognition or deferred consideration recognition. We'll look at that. Today, we'll start by looking at some basic tenets and principles that underlie all what we have been doing and what we'll do continuously with respect to preparing group accounts. And these are salient issues that requires a thoughtful process and understanding as we move on in this journey. And I will encourage us all to more or less effectively participate in this discussion. Okay, as we move on, we'll be making a reference to chapter 2 in our first session for today. We talked about basic principles of group accounts. Now, what are these principles? Okay, there are things that are well known to us or things that we've come across. And if we have not come across it before now, there are things that more or less underline our understanding of preparing group accounts, which are very, very interesting. Now, as we all know, we've talked about what group account is, starting from understanding what a group is and what makes two entities at least to be a member of a group is based on the relationship which is held by control. We mentioned that, and we have more or less talked about what control is in its own respect. Okay, various standards are going to have one or two effects in our journey as we proceed with respect to understanding how group account is prepared, especially in real life situation. Okay, now what matters most also is that there are terminologies that we have more or less discussed and we'll continue to unveil more. Okay, but this aspect of the book will make you have at a glance most of these terminologies in which you can be able to more or less refer to in case you need to have better understanding or to recall what it is. Okay, but again, we are not going to be discussing or defining them. There are things that along the line, as we come across them, we unveil them. And if you check, most of what you are seeing on the screen now have been unveiled in the course of this program as we have moved on. Okay, and I'm just showing you this for emphasis so that in case you need to have a quick view or a quick fix of your understanding of any terminology you come across, this is how you more or less, or this is an avenue to have a snapshot of it. Okay, now let's start with this. Okay, these are the salient things that we need to keep abreast of, and they more or less serve as one of the most important things we need to know and we need to apply. Okay, because financial reporting goes beyond just making computations, making illustrations. It's about having understanding of the basic principles that underline the modus operandi of you communicating financial information in an appropriate manner that depicts the activities and events that has occurred in the course of an accounting period. Now, the first thing we'll emphasize here is the rationale for having to prepare or present a consolidated financial statement. Now, consolidated financial statement is more or less the literal description of a group account. Okay, what that implies is that group account is otherwise known based on the requirement of IFRS as consolidated financial statements. And if you recall, when we were unveiling conceptual framework for financial reporting, you'll find out that we discussed about aspect of financial statements, which was chapter 3 of the conceptual framework. And in our discussion then, we discussed about financial statement coming in various forms. Those that are considered unconsolidated, which are financial statements of single entity. Those we consider as consolidated financial statement, which is a financial statement of a group. And those we consider as a combined financial statement, which is that of companies that are under common ownership, or one like say common individual ownership rather than corporate ownership. Okay, now when we look at that, therefore it gives us a sense of understanding of where we are coming from. Now, in this case, let us try to identify what are obvious justification or reasons for presenting consolidated financial statements. Because sometimes people ask me, and in the early stage of my career, I also ask myself those questions to say, if I have financial statements of a subsidiary or subsidiaries, and I have financial statements of the parent, what is limiting me from making decisions from those statements rather than still waiting for those statements to be combined as one for me to make decision? Sometimes when we look at the process of elimination, some people get to say that won't it also limit understanding of the full events and activities, since certain events common to both parties has been eliminated, which means the group account may not necessarily show all of it, because what relates or what transactions that have been consummated between the parent and the subsidiaries has not been reflected, because those has been eliminated. Therefore, for every question, there's a justification for it. Okay, but again, we need to look at it holistically and try to appreciate the rationale or the reason behind us presenting consolidated financial statements. Okay, but the beauty in this part of the world, when I say part of the world, even though we have some other people outside Nigeria in this program, But the beauty in Nigeria is that CIMA, both 2004 and the most recent CIMA, which is CIMA 2020, recognizes the fact that even when you as a parent has the responsibility to prepare group accounts, you still have the responsibility to present your own separate financial statements. Which that means that even if you try to say group account has eliminated your intercompany transactions and balances, you can find such transactions in the separate financial statement of the parent. And likewise, financial statement of subsidiary is equally available, provided it's a publicly listed entity. You can also find that there. Which then means that that has more or less eliminated the concern about loss of information or not having the holistic information. But in some part of the world, okay, based on the sophistication and advancement, the parent company is not required to present its own financial statement once it is presenting the combined financial statement. Therefore, probably in that kind of a region, that might still be of a concern, okay? But, you know, there's nothing that is 100% perfect. Everything has its own pros and cons. But one thing you weigh at every point in time in making decision is to weigh what gives you an optimal solution. And what it means is that what gives us the best, or I won't use the word best, what gives us the optimal solution to this problem or this conundrum is that group account is still much more required and necessary than not doing it. Okay, now let's look at some of the justifications, even though what we are going to discuss here may not be exhaustive. Okay, but it more or less represents the larger rationale for presenting consolidated financial statements. One of it is that it presents financial information about the parent undertaking and its subsidiary undertaking as a single economic unit. What it simply means is that if you look at a scenario where, okay, let's look at this real scenario. We are aware that Diamond and Access Bank, whether we call it a merger or we call it acquisition that later subsumed, as of today, the M&A or the business combination resulted in the production or in presenting a single entity, which is now Access Bank. Now, therefore, there's no problem about that. Let us now liken that with NIMCO and Mobile Nigerian PLC, where NIMCO acquired Mobile, and today they both operate separately. If we are to just merely combine the financials of the two, or as a decision maker, I just pick the financial statement individually and I try to sum it up, that will not necessarily show me the true economic and financial position and performance. Rather, what is just showing me is the additive modeling of the performance and position of those individual entities. Therefore, what group accountants to do is to say, if NIMCO is to subsume Mobile, the same way Diamond subsumes, the same way Asset subsumes Diamond, therefore, will that result be the same? The answer is no. All because intercompany transaction between them will have overstated the amount of assets and overstated the amount of liability. Even though your profitability may remain the same, but will have overstated your revenue and overstated your expense without necessarily changing your bottom line, which is your profit or loss. But what that means is that it will be obvious when you carry out metrics or financial ratios of some other relative analysis, and you find out that the results are not necessarily the same. And that's why consolidated account tends to ensure that whether you subsume Diamond the way Access has done, or you leave Mobile PLC to run separately the way NIMCO has done, your combination should give similar results, regardless of the nature or the structure of such a combination. And that's what that tends to address by the way of presenting the account based on single entity concepts. And that is what formed the basis of preparing group accounts. The second thing we need to know is that it assists us to show the economic resources which is available to the group at a glance. Economic resources available to the group is what it can derive from third parties, which means from other parties outside the group. Okay, which then means that if we fail to have consolidated and we are just showing economic resources individually, by the time we sum it together, most times such economic resources will have been overstated because part of what we consider to be from third party is still sitting within the group. And that is one of those reasons for presenting group accounts. Another reason is that it shows the obligation of the group to third parties rather than showing the combined obligations of members of the group. What does that mean? Showing the obligation of the group signifies that obligation to a group should be obligation payable to third parties, not necessarily obligations of individual members of the group, which is summed up together. Why? Because most times the sum of such obligations individually of the members within the group will have been overstated. Why? Because sometimes as a result of transactions that goes on within the group, there are obligations owed to one member of the group by another. And therefore, that also speaks volume of the essence of presenting consolidated financial statements. Another thing that is critical there is that it shows the result of the group as achieved by group resources employed, which means when you talk about revenue, revenue of the group should only be attributed to those earned from third parties, not necessarily the sum of revenue collectively made by every member of the group, because we are aware of the fact that some revenues are internally generated based on crossing of transactions between members of the group. What that means that if I buy an item and I sell it to my member of the group, and my member of the group sell it to another third party, invariably, mere adding my revenue with that of my subsidiary has not reflected what actually constitutes revenue to the group. Because revenue to the group must be traceable to those that were done extremely and strictly with third parties. Another thing we need to also understand is that it assists to prevent the preparation of misleading account by means of inflating revenue, okay, which is what I've also explained in depth. Okay, it also assists us to provide better measurement of performance. As I've told you, even though if you combine by not eliminating based on the single entity concept, you may still get the same profit results or loss results. But when you carry out relative analysis, when you carry out performance measurements or performance attribution, subject to things like ratios, you'll find out that you are not necessarily representing the same results. For example, if the parent sold goods worth 100 million, 20 million of such goods were sold to subsidiary, and subsidiary sold those 20 million to third party for 30 million. Mere adding our revenue, we show group revenue of 100 plus 30, which is 130 million. Okay, but when you look at the profits, when you measure the group profit as a ratio of 130 million, it will show a dismal performance as when you compare it to say, what is the actual sales of the parent to the subsidiary? It's 80 to the third party, it's 80 million. That 20 is not part of it because that 20 is already captured as part of the 30 that was made by the parent, by the subsidiary to the third party, which means invariably, it is not 130 million, but rather it's 110. How is it 110? 80 by the parent to third party and 30 by the subsidiary to third party, which make up 110, rather than 130, which make 130. Therefore, when you start to do such relative analysis, you have better understanding and appreciation of such a wrong communication of performance by mere just summing up the position or the revenue of the subsidiary with that of the parent. Okay, finally, EPS, we know what we call EPS, earnings per share. Earnings per share is one of the most important, if not most important, metrics for measuring performance, especially for a publicly quoted entity. And in that regard, it plays a vital role. And in computing earnings per share, you need to consider holistically from the single entity concept. Otherwise, you will be depicting what is not necessarily a measure of the performance of the group by mere combining individual accounts rather than adopting the consolidated financial statements. Now, at this point, I want us to make the floor is open. I don't want to call names, but I think I'll be forced to call names.
I think we lost connection with you. I don't know whether I'm the one from my own end.
Okay, yes, there was a loss of connection. Now I'm back. I've said, can any one of you guys contribute to what I've discussed so far with respect to the rationale for presenting consolidated financial statements? I'm waiting. Okay, I think I'll call names. Mr. Nuruddin. Mr. Nuruddin, we'll wait for you. Can you hear us? Okay, Mr. Shegun.
So I will just speak on one or two of the reasons for preparing consolidated financial statements. The first one is that it presents financial information about parent undertakings and its subsidiary undertakings as a single economic unit. So rather than having both entities preparing their financial statements separately, and if we need to do any if we need to do any assessment, we have to start looking at the parent financial statement and look at the subsidiaries financial statement at the same time. That will be clumsy, and it can take a lot of time. So in order to present it as a single unit, which they are, so that is one of the reasons why we consolidate the accounts. to present it as a single economic unit. It shows the economic resources controlled by the group. Yes, it presents the economic resources controlled by the group because it also eliminates intercompany balances, such as what the subsidiary is owing the parent or what the parent is owing the subsidiary. So presenting group accounts enables us to eliminate such intercompany balances, and we present the accounts that reflects the economic resources of the entities.
Okay. Thank you. Who else? Who else want to contribute?
For me, I would like to say, I think one of the rationale, which I think is the primary of it, is for them to have a robust financial statement that will enable them to actually be able to secure more business opportunities, and also for sustainability of business. I think that's why consolidation is actually essential, so that it will help them to have a bigger, like a good economic skills in terms of business opportunities that will come their way.
Okay, I think that speaks more to reason for even going into acquisition or merger. Okay, the emphasis here is much more of you have done acquisition or merger, or let me say acquisition, and you have a parent and you have a subsidiary. Why are you necessarily combining the account? Why can't you be presenting the account individually? Who else before we move to the next level? Who else? Let me call a lady. Madam Anne, can you contribute? And from there, we'll move on. Madam Anne?
Okay. I think for me, the overall, hello, I'm speaking.
Yes,
can you hear me?
We can hear you.
Hello?
We can hear you.
Hello?
We can hear you. Go ahead. Hello, Madam Anne, we can hear you. Okay, Miriam, can you take over from that? I think our network is bad.
I don't have much to contribute. It's explanatory already. You try to explain to us the rationale of having consolidated financial statements. So I think Mr. Shegun has explained, and you have also explained, and it's explanatory already.
I would just want to hear your own view about, from your own perspective, which one will I prefer Is it to have group account or to have the individual financial statement presented?
From my own perspective, I prefer to have the group account because of the rationales behind it. Like it will help me show a better performance of the company as a whole, and then it will also I think it will also help to eliminate errors, or maybe there's a miscalculation from the subsidiary, and by the time you're consolidating, you're able to see that and present the right information.
Okay, thank you very much. Let's proceed. The next thing we want to consider here is what are the basic accounting issues in business combinations? Okay, and there are a series of issues that come up as a result of business combination and its accounting. But again, let's look at these germane ones. Okay, I remember every of our discussions will never be exhaustive. There are more other things that could warrant what we have discussed or that could justify or negate our discussions. But again, we only more or less restrict ourselves to discussing on the ones that constitute the major burning issues rather than the whole population of issues. Okay. Now, one of the critical things that we need to understand is that how do you properly recognize, or let me start from identify, and thereafter recognize and measure assets and liabilities of the combined entities, especially of the acquired entities. What does this mean? You find out that one of the acquisition methodology of accounting, and one of the critical emphasis of that acquisition methodology of accounting in a business combination is that having identified the acquirer, the other business or businesses are the acquired business or businesses. And the first hurdle the acquirer need to cross is to ensure that it's identify all assets and liabilities of the acquired entity. The word identify means that you are not limited by what is in the books. Take note, you are not limited or constrained by what is in the what? In the books. There are some things in the books that they are just assets that are fictitious, or assets that might have been overstated, or assets that are unnecessarily understated. There are also things that are not in the books at all that could constitute an asset of that business. Likewise, liabilities. The most important there, which is contrary to the requirement and provision of IAS 37, is that contingent liability of an acquired business, once it can be fair valued reliably as at the date of acquisition, must be recognized, which is contrary to a single entity where IAS 37 says contingent liability should only be disclosed. But the same entity that discloses its own contingent liability not recognizing it, if another entity acquires it tomorrow, such liability will be recognized provided it is present and it is reliably going to be measured at acquisition date fair value. Which then means that that is a hurdle that you need to cross. Business combination is not as easy as we find it in these papers or our discussions. If you have been involved in one internal restructuring or external acquisition, you will understand what it is. That is beyond what is on paper. That's why due diligence takes care of most of these aspects. Do you get what I'm saying now? You know, when you are coming newly to a house, that's when you see things that are obvious, which the former occupier of the house does not take into cognizance because, you know, you are too familiar with the house that many things you overlook. But as a new tenant, virtually you'll be seeing everything as if you are a spirit. Are you getting what I'm saying now? And therefore, these are the similar things or analogy I can more or less use for you to have better understanding of the phrase that has been used there. The second issue there is, how do you recognize if there's any goodwill or gain arising from a bargain purchase transaction in this business combination? Though you say, goodwill is the essence of the purchase consideration over the fair value, all that one is just theoretical. It goes beyond that, because the question is this: all the assets and liabilities, having identified them, and for you to recognize them, you need to obtain their value, not necessarily what is being carried for in the books, but most times, for some categories of assets, you have to carry out what we call a fair value measurement for them. Okay, and it then means that you must be able to more or less remeasure all of the assets and liabilities identifiable and traceable to the acquired business. And this must be carried out based on all metrics, based on all conditions, based on all informations and assumptions that existed as at the acquisition date. Another thing that is critical is, from the point of acquisition day accounting, any form of intercompany balances that exist before or during and thereafter must always be tracked and be eliminated. At every point in time, you want to present a combined account, including when you are presenting the first account immediately after the merger or the acquisition. And lastly, what manner and what policy are you adopting in recognizing and measuring non-controlling interest as at the acquisition date? And as we are all aware, that non-controlling interests are interests in a subsidiary other than those that are attributable to the parents. And this is where you sit down and formulate your accounting policy towards recognizing the portion of the equity of the group that can be attributed to non-controlling interests. Any consideration, any addition, any real life instance that we want to bring to the floor on what we've discussed so far on basic accounting issues in business combination? Madam Grace. Kindly unmute, ma'am.
Yes, sir.
Yeah, we need your experience here, ma'am.
Let's see. Yeah, like you have explained, sir, that business combination, acquisition or merger, whichever one is in place, that to have a group account, a consolidated account for the parents, which capture the transactions for both the organizations. There are things that we need to pay attention to, which are intercompany transactions that needed not to be captured to avoid duplication. And you've said so many things.
Okay.
Okay, can
Okay.
I add to that?
Okay. Yes, you can go ahead.
It's all right. When you were talking about the reason, I mean, when you were telling us that it is very important to go beyond the assets and liabilities stated in the books of the subsidiary, I could really identify with that because I was also involved in something related to that when I was working back in Nigeria with BDO. Like we conducted kind of due diligence for 3 stockbroking firms that wanted to combine together. And we had to review all the financial statement areas, including all assets, expenses, liabilities, and most especially the tax aspect, because there were some unpaid taxes from that some of the companies had carried for a very long time. And, you know, those things really, we were able to look at it, and it gives the other parties to the business combination the real financial situation of each member companies that want to come together. So I just want to tell you that when you were explaining that we need to go beyond what is stated on the financial statement to really dig deep into what exactly is happening in the company, I could seriously identify with that.
Thank you. Thank you very much. You know, that's why you find out that most times new accountants, when they get organizations, they always make a conclusion that like accounting in practice is totally different from accounting in land. It's because they fail to understand that when you read something on paper, it's just like trying to reflect the real life stuff on paper, which is not the reality. And that's where abroad, when you are studying a course, you do internship, where you can be able to more or less take that paper into reality, and they'll show you the process. And once you do that over time, you can be able to understand how the paper or theory fit into the practice. You understand? And that is what we are saying about it. Because people felt group account is just get me financial statements, just consolidate, submit it, and that's all. As easy as it is in examination or in class discussions, even when we get to presentation of financial statements, practical aspects, you see that in real life, when you just take a trial balance on paper and you now prepare account on paper, you now say that's your financial statement. So you can say now. Therefore, how do you ensure that all what you have learned in theory, you're able to demonstrate it in practice? And that's why when you see that in engineering, computer science, and everything, you must have laboratory where you can display it. It's not paper, because paper will not do anything. Paper is just a way of trying to simplify that for your better understanding, depending when you go on the field to see the reality. Does that make sense, please?
Yes, sir.
Okay, thank you for that, your contribution. Okay, and this is a workshop. We need to reiterate it. This is not a place where we just give answers. We don't, we are to mine solutions, which means first is that we identify problems and collectively we mine solutions. You know, the way technological experts now, they come together by way of strategic alliance to mine Bitcoin. That's the same way we are also coming together to mine solutions to identified accounting and business problems. Okay, that is that. Now let's look at the next one. Now we are now looking at what is the objective of IFRS 3. Now, IFRS 3 talks about business combination and its accounting. What does IFRS 3 tends to achieve? And this will be in line with what the board, when I say the board, the International Accounting Standard Board, IASB, more or less presupposes as the objective for setting accounting standards for business combination, which is IFRS 3. Okay, Marian, I want you to read this out and we discuss it together. Okay, I think our network is off. Okay, Akin Falari, I want you to read this objective of IFRS 3 to business combination.
Okay, so objectives of IFRS 3 to business combination. The overriding objective of the new standards is to improve the relevant representational faithfulness. Okay, thank you. The objective of, I want to come again now, thank you. The overriding objective of the new standards is to improve the relevance, representational faithfulness, transparency, and comparability of information provided in a financial statement about business combinations and their effect on the reporting entity by establishing principles and requirements with respect to how an acquirer in its consolidation, in its consolidated financial statement. One now, recognize and measure identifiable assets acquired, liability assumed, and the non-controlling interest in the acquiree, that's if any. Two, recognize and measure acquired goodwill or a gain from a bargain purchase. Three, determine the nature and extent of disclosure sufficient to enable the reader and users of financial statements to evaluate the nature of the business combination and its financial effects on the consolidated reporting entity. Four, accounts for and reports non-controlling interest in subsidiaries. And fifth objective now, deconsolidate a subsidiary when it ceases to hold controlling interest in it. Thank you. Our next page. Okay.
No, that's all. Okay, thank you very much. Okay, you could see that what IFRS 3 tries to do is to give us a guide as a result of the accounting issues we have identified up there. And this guide, once we follow it methodologically, we'll be able to address the issues and we'll be able to have a smooth sail of arriving at appropriate accounting for the combined business upon acquisition. Okay. Now we've discussed control. What other things I want to discuss is consolidated financial statements. And Babajide, I want you to read this. Okay, let me enlarge it. Okay.
Okay. This is the consolidated financial statement. This is the financial statement of a group, parent and its subsidiaries, presented as those of a single economic entity. It is expected that a parent company prepares and presents consolidated financial statements that incorporate the financial statements of all its subsidiaries, both foreign and domestic. The basic consolidation procedures to be followed in order to prepare and present the consolidated financial statements of a group entail to A, combine like items of assets, liabilities, equities, that is, those attributable to that is, those attributable to post-combination. That is, those attributable to post-combination transactions and events, income, expenses, and cash flows of the parent with those of its subsidiaries. B, offset the carrying amount of the parent's investment in each subsidiary and the parent's portion of the equity of each subsidiary. IFRS 3 explains how to account for any related goodwill, which will be discussed in the context to this test as at acquisition date. C, eliminate in full intra-group assets and liabilities, equity, income, expenses, and cash flows relating to transactions between entities of the group, profit or loss resulting from inter-group transactions that are recognized in assets, such as inventory and components of depreciable non-current assets are eliminated in full. Intra-group losses may indicate an impairment. Intra-group losses may indicate an impairment that requires recognition in the consolidated financial statement. IAS 12 income statement applies to temporary difference that arise from the elimination of profits and losses resulting from intra-group transactions.
Thank you. Now, this more or less reconfirm what we have been doing with respect to presenting consolidated financial statements. Okay, I only brought us back so that we can understand that there's a framework to everything we do. Okay, that is what makes it a gap. Generally accepted accounting principles. Okay, we are not just doing things out of the blues, but we are doing things based on what has been generally accepted as the best principle and practices to presenting financial information arising from all of these kind of business transactions. Okay, now one thing that's also critical is this. Are you aware that not all times you may be required to present consolidated financial statements or to present group account as a parent entity? Are you ever aware of this? Are you aware of this before?
Yes.
I want a practical answer to it. And have you seen an organization that have done this before? That they have subsidiary, at least one, and they don't present group accounts. Let us more or less bring it home. Have you ever come across such? Babadi said yes. Can you tell us your experience without naming names, but just give us experience? Babajide, we can't hear you. You are muted. Babajide, you are muted. We can't hear you.
I fully don't want to explain based on what I'm seeing, but I'm aware that some...
I'm not saying you should look at what you are seeing. Just you find yourself in a situation where a parent does not consolidate its subsidiaries, which means it does not present consolidated financial statements. If you find yourself in that situation, can you also explain the rationale and some other things without necessarily naming names or anything?
Okay. I think I'm aware of some companies that are by name. They said it is group something group limited. You know, which means that it has subsidiaries in which they have acquired a high percentage of their shares, and in the long run, but they are not consolidating.
maybe as a result of the fact that there is a public interest in them, or maybe I can't really bust stress.
Okay. Who else?
I'm not aware of any, but I would like to learn. I'm not aware.
Okay, Madam Olado, welcome. Can you give us instances?
Good morning, sir. I'm not aware of any group that does not prepare a consolidated financial statement. The only one that what I know by books is that if it does not have control over it, it's a subsidiary, but it does not have a control. That's when it does not prepare. But I'm not aware. I've not seen any situation like that before.
Okay. Okay. Now we'll be aware today of the instance in which a parent company may not present group accounts. Okay. And we are going to break it down into something that is of reality. There are 4 things that must exist for such to happen. And listen to me, those conditions must be fulfilled in whole, not in part. And that's why you find it that barely do you see such situation exist where you don't present group accounts, but they are. And over time, we get to familiarize ourselves with it. Mostly, you find it where the parent company is not even quoted, or even when it's quoted, there's a justification for it, and I will explain. The first condition is this. If the parent entity itself has a parent of its own, that means if entity B is the entity in question, is a parent to entity C, entity B may not present consolidated account if entity B is a subsidiary of entity A, which means the person you call parent still has a parent, and his own parent presents group accounts. That's the first condition, which means I don't need to present group account of my subsidiary if my own parent prepare group accounts. My own parent will be considered what we call the ultimate parent. Because remember, the ultimate parent has responsibility for everything within the group, even if it is what belongs to his own subsidiary. Remember the structure we did, subsidiary, joint subsidiary, and also options. The ultimate parent has overall responsibility. Therefore, if I have an ultimate parent, I need not bother to present group accounts. But again, it's not just giving a la carte. It's not just as easy as that. You go about that provided your parent that you are talking about presents group accounts in line with IFRS. Where the problem lies is that if your parent is a Nigerian company and you two are a Nigerian company, you know that your parent will prepare under IFRS compulsorily because it's the law. But if your parent is in US, therefore, and your parent prepare account in US GAAP, which is not IFRS, therefore, that condition does not apply again, which means you have violated that condition. Therefore, you must present group accounts. But if your parent, whether in UK, in US, in Nigeria, present group account in line with IFRS, therefore, you are immune. You may not go ahead to present. The essence of this is to eliminate unnecessary cost and burden for presenting group accounts, since your ultimate parent has done so. But it's not all exhaustive. It's also possible that you, as a company, is not a PLC. Watch my language very well. If you are a PLC quoted in Nigerian Stock Exchange and you have a subsidiary, whether your parent is Nigeria or is in US or is in UK, and whether they prepare group account under IFRS, it doesn't apply to you. You must still present group account because you are a quoted company in the capital markets. Because you have some other shareholders that has no interest in the ultimate parent, which their interest stops at your own point in the capital markets, where your shares are freely traded. Therefore, you must present group account. Otherwise, you can't present, you may not present if you are not quoted. Again, even if you are not quoted, but you have your security, such as bond, commercial papers, listed in the capital markets, not as equity. You are not a PLC, but you issue bond or commercial paper that is listed in FMDQ exchange or in stock exchange, Nigerian Stock Exchange, or anywhere you find yourself. Therefore, you already have an exposure to the capital market. Therefore, you must present. It's only when you don't have any equity, any security at all, whether equity or debt, in the capital market. And again, even if you don't have equity or debt issue in capital market and you are not listed company, you only will not, if you are not in the process or you are not required by any Security Exchange Regulation or Investment Security Act to file a return to such a regulatory body like SEC, which is equivalent of SEC is FSA, Financial Security Authorities, and etc. in other countries. In such a situation, if you are not required to file, regardless of all of other conditions, you still need not to present group account. But if you still have a responsibility to file, or you are in the process of filing because certain status need to change in the immediate future, such exemptions does not apply. Such exemption does not what? And these are the conditions that more or less precedes your exemption from presenting group what? Accounts. Can somebody summarize it? And I'll now put scenarios. And I'll use that scenario to depict your understanding. Who will summarize what I've said with respect to conditions that need to be met for you to be granted such an exemption for from not presenting consolidated financial statements?
Okay, let me try. I think there are about 3 or 4. If my brain will pick. So you can be exempted from preparing a financial statement if the certain conditions are met. One of the conditions is that if you are a subsidiary to another parent, that is, if you yourself, who is a parent to another subsidiary, is also a subsidiary to another parent, and your parent is expected under statutory requirements to present financial statements. In such a case, you are not expected to prepare a financial statement. However, if such a case applies to you, you are expected to then prepare a financial statement if in any way you are a quoted company in, for example, the Nigerian Stock Exchange. Or on the other hand, if by reporting duty, you have the duty of preparing or presenting financial statements to such a body such as Exchange Commission, the SEC, in such a case, you are expected to prepare a financial statement. Another condition that could make you prepare a financial statement is in case any of your securities or debt are listed in the market, in the exchange market. In such a case also, even when you have a parent that is expected to prepare a financial statement on your behalf, you also are expected to prepare a financial statement, especially for your shareholders or stakeholders that may not have anything to do with your parent company. Another condition, I don't know if I've mentioned that just now, is if your parent is under a different kind of regulation. That is, the example made earlier is if your parent now is preparing his financial statement under a US GAAP and you are a Nigerian company, in such a case, you are expected to prepare a financial statement in line with IFRS, being the regulatory requirements in Nigeria. I hope I'm able to capture the point. Thank you.
Okay, thank you very much. Okay, who else? Who else? Madam Anne, I think your network should be better now.
I want to ask questions.
Okay.
Between the point 1 and point 4, I want to is there any difference?
Hello? Point 1 and point 4, they're totally different there. Point 1 is talking about whether you are only owned subsidiary or you are partly owned subsidiary, okay, of an entity, and all other owners, including those that does not have right to vote, have collectively agreed that you don't need to present group accounts. You understand? What that means that what we are saying there is that even if your ultimate parent prepared group accounts, okay, in IFRS, you cannot automatically say you don't present if you are not only owned subsidiary. Or if you are partly owned subsidiary, you must ensure that other shareholders that are considered non-controlling interest or minority interest holders agree to it. Otherwise, if they fail to agree to it, you cannot. The only time you can just have a smooth sale is if you are only owned, not if you are partly owned. If you are partly owned, you must still ensure that you get consent of the majority of the non-controlling interest holders. Does that answer your question now? Okay. Now, there's a technical note here. If peradventure you met all of these conditions and you do not present group accounts, you must at least comply with the requirement of IS 27, which talks about separate financial statements. As we move on, we'll get to IS 27 to look at what it says with respect to accounting for investments by an investor in a subsidiary, associate, or joint venture, and also the disclosure requirement for such an interest in other entities. Okay, now let's move further again. There's also an exemption that is extended to an investment entity. Have you heard of the amendment to IFRS 10 in 2014 with respect to investment entity? Now, I want Shegun to read this, and we'll now bring it to bear. What kind of entities qualify as an investment entity?
Okay, investment entities consolidation exemption. IFRS 10 contains special accounting requirements for investment entities. Where an entity meets the definition of an investment entity, see above, it does not consolidate its subsidiaries or apply IFRS 3 business combinations when it obtains control of another entity. Technical notes. The investment entity consolidation exemption was introduced by investment entities issued on 31st October 2012 and effective for annual periods beginning on or after 1st January 2014. An entity is required to consider all facts and circumstances when assessing whether it is an investment entity, including its purpose and design. IFRS 10 provides that an investment entity should have the following typical characteristics. It has more than one investment, it has more than one investor, it has investors that are not related parties of the entity, it has ownership interest in the form of equity or similar interests.
Okay, now with this explanation, can anybody give me a practical example of an investment entity that will not be required to present group accounts? You know, you've seen the quality and attributes of an investment entity. Can you now give me details of investment entities, whether in Nigeria or anywhere, that are well known? I don't need the name of the company, but I need you to describe the structure of such an investment entity that may not present group accounts or that are exempted from presenting consolidated financial statements.
A mutual fund entity that has many people investing in their business, and it also invests in different lines, be it shares, be it real estate, on behalf of their investors. So I think it might fit in this scenario.
Yeah, you got it right. Mutual entity is one, unit trust is another, hedge fund is another. Various investment management entities like that are what we consider as investment entities. Because some of them might have equity stake in another entity that may have given them control. But the control, by the nature of it, is not control for the management. You know, they are investment vehicles whereby once they seek capitalization, they jettison, they exit, and they move on. And the portfolio is not held by one single individual, it's multiple, it's a pool of funds. And therefore, their strategy and objective is totally different from holding control for the purpose of managing the business. Are you getting it now? And that's why they are giving that exemption. But not that they cannot, but it adds little or no value because they are not there solely for the purpose of management or anything about the business other than for capital appreciation, and is a pool of funds in which by nature there is always multiple entries and exits in all of their dealings. Okay, what we are simply saying is that not all entities may present group accounts even where they have control. apart from the condition we have discussed earlier, with respect to you having ultimate parent, you only hold subsidiary and all sorts of things. Another one that may not meet that condition but is exempted is investment entity. And we have classified investment entity in line with IFRS 10 as that has the following characteristics. It has more than one investment. It has more than one investor. It has investors that are not related party to the entity. And it has ownership interest in the form of equity or similar interest. Okay. Any other question regarding that? Now we are going to wrap it up with exclusion of subsidiary from consolidation. There are two different things between exemption. Yeah.
Okay. I want to confirm, according to IFRS 3, this definition of investment entities, based on these characteristics, must the 4 items there be fulfilled, or is it any of it?
Not any. First, it is IFRS 10 that defines investment entity. Okay. The 4 conditions or the 4 characteristics must be fulfilled. That is when you qualify as an investment entity. And that's why if you check the following entities: mutual funds, hedge funds, unit trusts, and some other crowding funds and structure vehicles like that, they are mostly investment entities. Is that okay?
Why I asked that question is I really don't know of any specific one, but I'm trying to think on my head. Many of these mutual funds, many of them, in my opinion, they may not have more than one investor. I think they are usually one business, one investor, and they try to manage their books. I don't know any internal thing, but that's why I asked that particular question.
No, I don't think you are totally correct when it comes to mutual funds. Mutual funds to the best of my knowledge, they are not one investor at all.
Your internet, sir.
There are multiples, hundreds, thousands of investors in mutual funds. Okay? Except you are talking of private equity funds or you are talking of venture capitalists. You understand? Mutual fund are pool of funds. I said, except you are talking of private equity funds or you are talking of venture capitalists, but mutual funds are pool of funds running into hundreds and thousands of investors, which is ETF, hedge funds, which all of these are investment entities to the best of and venture capitalists. Okay, now let's also use the opportunity to look at them on net. Let me try and Google it and let's pair them because this is a workshop where learning takes place. Let me try and share my screen. Let's look at mutual fund. Okay, can you read? Okay, you're on phone. Marian, can you read what a mutual fund is? Marian, can you read that?
Okay. Can I read?
Okay, read.
A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors.
Oh, your network is your own network. Marian, is your own network. Marian, is your own network. Asama, can you continue?
Okay. So,
the screen hasn't changed.
No, is your Our network. Your network is poor. Okay, continue, Akifalayan.
Okay, by
Akifalayan,
definition,
continue.
a mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. Can I go ahead, sir?
Yeah, go ahead.
So a mutual fund give small or individual investors access to professional managed portfolios of equities, bond, and other securities. Each shareholder therefore participates proportionally in the gains or losses of the fund. Mutual funds invest in a vast number of securities, and performance is usually tracked as the change in total capital cap of the fund that derived by the aggregating performance of the underlying investment. Thank you.
Thank you very much. Now you can see that this is not, okay.
Is PFAs, are they mutual funds?
Okay, we'll come down to that, okay? Mutual funds, as you have seen, do you get what I'm saying now? It's not one person, it's not one individual or anything. Mutual fund is what it is, okay? Now let's compare mutual fund with this other kind of funds. Again, exchange traded fund. Okay, can you read this? Exchange traded fund.
An exchange traded fund, ETF, is an investment fund that holds assets such as stock, commodities, bonds, or foreign currencies.
Can you read it now? Continue.
An exchange traded fund is traded like a stock throughout the trading day at fluctuating prices. They often track indexes such as NASDAQ, the S&P 500, the Dow Jones, and the Russell 2000. Investors in these funds do not directly own the underlying investments, but instead have an indirect claim and are entitled to a portion of the profit and residual value in case of fund liquidation. Their ownership, shares, or interest can be really bought and sold in the secondary market.
Okay. Let me also use hedge funds. Okay, go ahead.
Hedge funds are alternative investments using funds and employ different strategies to earn active returns or alpha for their investors. Let me say that again. Hedge funds are alternative investments using pool funds that employ different strategies to earn active returns or alpha for their investors. Hedge funds may be aggressively managed or make use of derivatives and leverage in both domestic and international markets with the goal of generating high returns, either in an absolute sense or over a specified market benchmark. It is important to note that hedge funds are generally only accessible to accredited investors as they require less SEC regulations than other funds. One aspect that has set the hedge fund industry apart is the fact that hedge funds face less regulations than mutual funds and other investment vehicles.
Okay. Okay, let's look at unit trust.
Okay. A unit trust is an incorporated mutual fund structure that allows funds to own.
Hello. Repeat it. It's unincorporated, not incorporated.
Okay.
Go back to.
Thank you. A unit trust is an unincorporated mutual fund structure that allows funds to hold assets and provide for profits that go straight to individual unit owners instead of reinvesting them back into the fund. Mutual funds are investments that are made up of pool money from investors, which hold various securities such as bonds and equities. However, a unit trust differs from a mutual fund in that a unit trust is established under a trust deed, and the investor is effectively the beneficiary of the trust.
Okay, now can you see a common pattern in all of this? And all of the patterns satisfy the 4 attributes that was defined with respect to an investment entity in line with IFRS 10. Now, let me show you again. One, it has more than one investment. They don't just invest in one thing. They have various asset classes. Within asset class, they have various investment vehicles and entities, and they have more than one investor. That's why they call pool. The word pool means you are pooling from various individuals, small, medium, and large investors. It has investors that are not related party to the entity. When we say related party, it's not like a company that relates to that mutual fund professional is also doing, this is a pool that is available for as many people as possible. And also, it has ownership interest in form of equity or similar interest. And when you look at all of this, it's like you are an equity participant in the mutual fund, in the unit trust, in the hedge fund, in the exchange traded fund. It's only that the strategy and model operandi of regulation and other things, including strategy, is what differs from them, but they are the same thing. Now, let me now try to answer the question of Jide saying PFA. Now, the first thing to answer the question is to go back and let us ask ourselves what a PFA is. PFA means pension fund administrator. Who are pension fund administrators? Let us look at it from the perspective of PENCOM, which is Nigerian perspective. PENCOM is Nigerian Pension Commission. Now, who can read this out? Let me enlarge it. Okay, can somebody read? Who is a pension fund administrator? Akinfolari, can you read that?
Okay. A pension fund administrator is a company licensed by the National Pension Commission to manage and invest the pension funds in the employee's retirement savings account. To manage and invest.
Now, which is pension fund is like a pool of funds of various individuals who are also classified as investors. Therefore, in this case, PFA is managing on behalf of others like mutual fund and other things. The only thing is that his own regulation is very stringent, and such is not something you can pull out because there are conditions that have to be met and also all of things, which means a pension fund administrator also, for the purpose of financial reporting, will fall under investment entity, that no matter the stake they have in any entity, they cannot consolidate because they are given that exemption. Does that make sense now, Babajide?
Yes, sir. Because that's where I wanted to actually mention as an example of some of these companies when Folarin asks for examples.
Okay, let's now look at private equity funds or private equity. And Babajide, can you read that now?
Private equity is an alternative investment class and consists of capital that is not listed on a public exchange. Private equity is composed of funds and investors that directly invest in private companies or that engage in buyouts of public companies, resulting in the delisting of public equity. Institutional and retail investors provide the capital for private equity, and the capital can be utilized to fund new technology, make acquisitions, expand working capital, and to bolster and solidify a balance sheet. Private equity fund has limited partners who typically own 99% of shares in a fund and have limited liability, and general partners who own 1% of shares and have full liability. The latter are also responsible for executing and operating the investments.
Okay. Venture capital.
A venture capitalist is a private equity investor that provides capital to companies exhibiting high growth potential in exchange for an equity stake. This could be funding startup ventures or supporting small companies that wish to expand but do not have access to equity markets. Venture capitalists are willing to risk investing in such companies because they can earn a massive return on their investment if these companies are a success. Venture capitalists experience high rates of failure due to the uncertainty that is involved in new and unproven companies.
Okay, now what happened is this. Venture capital funds, private equity fund will not qualify as investment entity in this case because these are more or less those that are created by way of partnership or created by way of limited liability company to hold investment and more or less fund startup and all sorts of things. Therefore, those funds are not investment entity because they are not pool of funds. in that regard. And at every point in time, there is a relationship. Remember, there's something we said there that is something that it has investors that are not related party to the entity. But in most of the private equity funds and venture capital funds, they have such relationship to be. You understand? They do not necessarily satisfy the condition of an investment property, investment entity with respect to IFRS. But any one of it, which may be extreme situation, which satisfy that condition, may go ahead, provided it meets all of the conditions. But it's very rare for us to have a situation where such a private equity fund or venture capital funds qualify as investment entity for the purpose of the exemption from preparing group accounts. Take note, we are not talking of investment, we are talking of reporting. Is that okay? Okay, that is that. And I think that brings that to rest. Now, to wrap up this first session, we'll now look at the difference between exemption and exclusion from consolidation. Now, what is the difference between exemption and exclusion? Exemption means that a parent company may decide not to consolidate its subsidiary and will not ever present group account because it met those conditions or because it's an investment entity. But exclusion means that a parent company is presenting group accounts, but under what condition can it exclude a subsidiary or some subsidiaries from that consolidation? What does that mean? It means you have 2 subsidiaries and you only consolidated 1, you left the other. Or you have 10 subsidiaries, you consolidated 9, you left 1. Or you have 20, you consolidated 15, you left 5. On what basis can some subsidiaries be excluded from the parent consolidation? Have you ever come across that in real life, okay, of a subsidiary that was left out unconsolidated by its parents? The floor is open.
Okay, I don't have a personal experience of a group situation where the parent did not consolidate a particular subsidiary. But based on our discussion so far, especially the one that has to do with understanding what a business actually means, you made us to understand that before there can be business combination or consolidation at all, that a company must meet the definition of a business. So if it happens that one of the subsidiaries or one of the companies where the parent has purchased, maybe where the parent has 100% investment in that company, but the company does not meet the definition of a business. So there's no reason why the parent should carry out a consolidation of such an entity. So that would be my explanation to that.
Okay, who else? Who else? Nuruddin, I've not heard you speak today. I think your background noise should have gone now.
Okay, by now the background is friendly. Normally, I don't have a practical example of an entity that's a parent that exclude the entity in the real life practice. But like Shego explained, I have the same submission to that when an entity did not qualify as a business, there is no reason for the parents to consolidate such an entity. Thank you.
Okay. Any other person? Any other person? And now, I've not heard you speak today.
Good afternoon, everyone. You said without condition can a parent exclude a subsidiary from consolidation? I think that's the question. But is it in the shares? Is on the screen, and it says that where control is intended to be temporary. It's there on the screen so the answer is right there on the screen. So I just don't know what to have, but I can see when control is not intended to be, when control is intended to be temporary, when they engage in dissimilar activities, and also see a severe long-term restriction which can impair subsidiary and so on and so forth.
And we are not necessarily looking at the screen. We are talking of, have you ever come across it in practice, or you've heard of it, or any other thing with respect to a situation where a subsidiary is left out in the whole process of consolidation?
No, not at all. Not at all.
Okay, thank you very much. Okay, now, the issue is this. A subsidiary should not be consolidated along with others if the parent, as at the reporting date, no longer have control of that subsidiary. Remember, we know what control is. And the question then is, when can you say a parent no longer have control? The most obvious one of it is when the parent has disposed of all of his stake in the subsidiary. That's number one. Number two is, what if the parent did not sell off all of his stake, but he has sold significant amount of his stake that has made it to lose control of the subsidiary? Or he has not sold anything in stake in the subsidiary, but based on certain event and action, it loses control, which might be as a result of bankruptcy of the subsidiary, as a result of court administration, or as a result of any other event that presupposes that it no longer holds control of the subsidiary. That is when it is more clear and visible to the eyes that a subsidiary should not be consolidated. But there are instances where a subsidiary may be excluded, and this was done prior to the revision of the standard. Which means that in today's world, there are only two reasons why one is notable, which is the one I just explained. For you excluding a subsidiary from consolidation, it's only when the control of the subsidiary has been lost by any means. And I've explained some of the means to which control or actual control can be lost. Okay, that's only when you do not consolidate. But the second time you do not consolidate flows from the conceptual framework, rather from the IFRS 10. IFRS 10 talks about loss of control, and that's all. But from the conceptual framework, which says, in accordance strict accounting treatment to transactions, in order to fulfill the objective and benefit of financial reporting, such that the cost of reporting does not outweigh its benefit, you must ensure at all times to consider materiality of events and transactions. On the basis of materiality, you may not consolidate a subsidiary if consolidating the subsidiary or not consolidating it does not change the outlook, the position, or the decision that will have been taken by those that are stakeholders in the group. And a practical example is this. If I have 5 subsidiaries, and 4 of the subsidiaries plus me, which is a parent, our results represent 99% or more of the entire combined results. It then means that for the purpose of the group position based on single entity concepts, consolidating or not consolidating the last subsidiary that make up less than 1% of the whole group position will not materially change anything, whether we consolidate or not. And this speaks to the fact that we might have some practical issues with the subsidiary in question, whether his account is not yet provided or is having some critical issues that cannot make account available for consolidation. Therefore, instead of losing the 99% because of 1%, it makes more sense to jettison the 1% and hold on to the 99%, thereby proceeding in consolidating the remaining 4, leaving out the 1. Do you get what I'm saying now? And these are practical reasons where we might not go ahead to consolidate a subsidiary on the basis of immateriality. That is, such subsidiary is considered immaterial to the entire group position. Does that make sense now? Now, before now, there are other justifications which no longer fly. And that's why you find out that this is more or less grayed out. It's not like visible like every other, because these conditions are no longer sufficient, are no longer justifiable for not consolidating a subsidiary. And one of them is that when control is held for temporary purposes. The question is, when you buy a subsidiary with the hope of selling it immediately or restructuring it to sell, therefore it falls under the requirement of IFRS 5. IFRS 5 borders on non-current asset held for sale and discontinued operations. And what the standard says is that you can't say because it's held for temporary purposes, you should not consolidate. No, you should proceed in consolidating, but you consolidate in line with the requirement of IFRS 5, which means such condition of temporary purposes no longer owed for not consolidating a subsidiary. The other one is that before now, a subsidiary is not required to be consolidated if, for example, the parent is a trading company and the subsidiary is a financing company, financial institution like bank. Therefore, before we find out that there's no basis for consolidation, but we're saying that no, there's a basis for consolidation. You can consolidate them in such a manner that your operating reporting, operating segment reporting, will more or less explain the divergent view between the activities of the subsidiary and the parent that seems to be dissimilar in nature. And when we get to IFRS 8, when we talk about operating segment, you'll see how such can be done by way of reportable segments in line with the requirement of the standard. And finally, where you have a subsidiary, which is common, where your subsidiary is a foreign subsidiary, you are a parent in Nigeria, your subsidiary is outside Nigeria. Or you are a parent outside Nigeria, your subsidiary is in Nigeria. Once there's a capital flow restriction for repatriation, those days we'll say, under a such long-term capital restriction to repatriate capital or to repatriate dividend or return, you should not proceed to consolidating such subsidiaries. Such is no longer visible, which is mere having a long-term restriction of capital repatriation or otherwise is not a sufficient ground any longer for not consolidating. Rather, you proceed in consolidating, but in your disclosure of information, you more or less capture all information that shows the lack of free movement of capital with respect to repatriation in the country of the subsidiary. And that also speaks volume of if you need to subject the investment in that subsidiary along with any goodwill that exists in that subsidiary for impairment because of this restriction, rather than concluding that you don't consolidate. And that speaks volume to all what we need to understand with respect to this. Technical note here, I concluded by saying invariably, subsidiary will be excluded from consolidation only when control is lost, and or if it is considered will be deemed to be immaterial to the entire group operations and accounts. Does that make sense now? Does that make sense now? Okay. Any other question?
Okay, thank you very much. I think I put a question in the note earlier when we were discussing the exemption to preparing consolidated financial statements, where we have when a subsidiary is a parent, when a subsidiary as a parent that prepares a consolidated financial statement, it means that parent who is a subsidiary to ultimate parents is exempted from preparing consolidated financial statements. I asked a question that, is there a practical scenario for such an entity? I want to know for illustration purpose.
Is there a practical scenario?
Yes, for such an entity.
Not to do what? Not to consolidate.
Not to consolidate because the entity has an ultimate parent.
Yes, that's what I've said, that it is common when that entity is a private company. If it's a public company, it's not possible, which I explained, because there's no way a public company will be exempted, even when you have ultimate, because you are quoted in one market, and that market needs to know your full position, including that of your subsidiary. But if you're a private company, you will be wholly owned, because a wholly owned company can never be quoted because it's one shareholder. Are you getting it? Therefore, and if you are even private company and you are partly owned, other shareholders can agree, because there might be 2-3 other people that will say, what's the essence of consolidation? What I need is, I want to know what is going on in the company and what's the profit. You can say now. Therefore, that's why the practical example will be based on individual entities that you are fortunate to know as a private company. And even if you're a private company, if your security is quoted, such as your bond and everything, you can't apply it, which means you must have nothing to do with the capital market at all, given that you also have an ultimate parent that presents group account. Therefore, in that case, you won't be able to name names, especially in Nigeria, because private company information are privately held and not in the public space. Does that make sense, sir?
Yes, thank you.
Okay, sir, please, I would just like to say something. I have something I want to quickly add to something we discussed the last time regarding business combination. When I did further reading about it, I also come across that there is, regarding the revised IFRS 3, the basis for determining whether it is a asset acquisition or a business combination, I came across something like concentration test. I can't remember if we talked about it then, that there must be a concentration test that makes us to know whether it is a business combination or it is just an asset acquisition. That when the amount paid for the assets or group of similar assets makes up, when the amount paid for a group of assets or similar assets makes up so much, then it is regarded as asset acquisition. But when the amount paid, does not make up significant parts of the asset or group of assets, then it can qualify as a business combination. So I don't know if you can just help us throw more lights on this aspect of concentration test according to revised IFRS 3.
Okay, we'll look at that. There's something I'm sharing to you. Also, I've sent it to some, okay, but others have not gotten it, like the standards themselves, the compendium of the standards, including basis of conclusion and everything. You'll get it in your WhatsApp as time goes on. Okay. And what will happen is when we come back from break, we'll start from there. And I'll share some materials online, which you are going to see, and we'll look at it together. Okay. Any other question? Any other question? Any other question? Okay. In the absence of that, we'll go for a short break and we'll return in 15 minutes time. Okay, welcome back. Sorry for the 30 minutes interlude, which I have to attend to something that I thought I sent the chat, not knowing that it didn't deliver on time. Sorry. Can we put up our cameras to signify that we are back so that we can continue the class? Okay, we'll start from where we stopped. My brother asked us a simple question. Mr. Shegun, please kindly put up your camera. We're about to start because you asked the question and it will be much more good for you to be available on this discussion. Okay, Mr. Shegun is coming in now, and he will ask his questions again, and we are going to attempt answering that question before we proceed. Welcome, Mr. Yodele. We started the class since 10. We are just seeing you now. At least thank you for joining us.
Thank you, sir. I've been away. I'm very sorry.
Okay, Shegun, welcome back. Can you ask your question again on concentration test? And from there, we'll continue.
Okay. Yeah, what I was trying to say was that I went further to do a little more reading, and I realized that the revised version of IFRS 3 provides that we can determine whether an asset or group of assets that we are buying meets business combination or it's just an asset acquisition. And that was termed as concentration test. So I would like to know more about it, and if you can explain it to us.
Okay. Let me rephrase your question. That is, You want to know when you voluntarily or optionally make use of concentration tests in identifying whether a company meets the definition of a business without going through the rigor of the step-by-step requirements to observing whether it qualifies as a business. Okay.
Yes.
That revision was done in 2018, which took effect from 1st of January 2019. Okay. And it speaks volume of what constitutes a business. You understand? Which means what they are trying to consider is that, as we have said at the beginning of these classes, that not all acquisition made by a company to another constitute a business combination. Which means not necessarily do we consider that all companies qualify as a business. It is a company that qualifies as a business, or is an entity or enterprise that qualifies as a business that can be involved in a business combination. Now, what happened is that there was an annual improvement assessment that was done between 2017 and 2018 that made the revelation in which has made the board to tend to provide a simplified approach to identifying a business by way of fast track. And the fast track is the use of concentration tests. Now, to do that now, what I've done is that I've picked write-up that are industry write-up so that we don't want to theorize it. We want to look at it from the angle of the industry or practice. Okay, I've done that, I'll pull it up, even though I've sent, have you all seen the standards? I've sent you the standards on the WhatsApp. You guys should download it between now and 7 days before it expires. Okay, now what I'll do is that the same person that brought the question will provide solution by leading us in this discussion. Okay, what you are going to do now is that first document are presented before us is a document that is presented by PwC upon the issuance of that amendment before it took effect in 2019. Now, can you start with amendment to IFRS 3, definition of a business?
Okay. Is it the one on this slide?
Yes, I think I've shared the slide. In brief, look at the current financial reporting issues. Is that what you are saying?
Yes.
Yeah.
Okay. A look at current financial reporting issue, amendment to IFRS 3, definition of a business. At a glance, on 22nd October 2018, the IASB issued amendment to the guideline in IFRS 3, business combination, that revises the definition of a business according to feedback received by the IASB. Application of the current guideline is commonly thought to be too complex, and it results in too many transactions qualifying as business combination. What is the issue? New guideline, new guidance. To be considered a business, an acquisition would have to include an input and a substantive process that together significantly contribute to the ability to create outputs. The new guidance provides a framework to evaluate when an input and a substantive process are present, including for early stage companies that have not generated outputs. To be a business without output, there will now need to be an organized workforce. The definition of the term output is narrowed to focus on goods and services provided to customers, generating investment income and other income, and it excludes returns in the form of lower costs and other economic benefits. It is also no longer necessary to assess whether market participants are capable of replacing missing elements or integrating the acquired activities and assets. An entity can apply a concentration test that, if met, eliminates the need for further assessment. Under the optional test, where substantially all of the fair value of gross assets acquired is concentrated. I can't see the screen again. Okay, an entity can apply a concentration test that, if met, eliminates needs for further assessment under the optional test, where substantially all of the fair value of gross assets acquired is concentrated in a single asset or a group of similar assets. These assets acquired would not represent a business. We can't hear you. We can't hear you, sir.
Okay, sorry. I didn't unmute myself.
Okay.
I said this speaks to the first level, to appreciating and understanding the revision to the standard. Okay, the next level is for us to have a better understanding of what we're saying. Before now, we said a business comprises of input, process, and output. And that a business can still be considered to exist when you have some level of input and you have process in place, which might not be a complete process. And what the annual improvement and feedback has provided is that allowance of not necessarily more or less defining the depth of process that need to be in place has allowed many asset acquisition to fly as a business combination. Therefore, what has changed? One is that instead of using mere process in place, they've used the phrase substantive process. The word substantive process is that from my own, if I want to quantify it, I could say process that account for not less than 75 to 80% of what is required to be in place. Okay, even though the term substantive will be subjective, but again, it will be subjective, but not to the extent that it will not be visible to the eyes to know that this actually exists. That's number one. Number two there speaks to the fact that when output was initially defined, output was elaborate to include provision of goods and services, investment returns, income generation, issue of return on investment, and some other things. But what they have done in this case is that instead of making it open-ended, such that asset class investment, which does not necessarily qualify as a business, would not have been wrongly captured. Therefore, they have streamlined it only to focus on goods and services provided to customers, generating investment income and other income. And it has now excluded returns in form of lower costs and other economic benefits. That's another thing that was taken into consideration. Another thing that was taken into consideration is that even though we recognize by the nature of some entities, output might not be visible in the earlier stages. But even if output is not visible, what they have considered now is that there must be a workforce in place, which means there's a workforce, which means the human resources are in place, which is more or less organized in a way through the process that they are more or less working toward an output. And that is what they mean by the workforce being in place. This has now slightly given a sense of direction to clearly identify what is a business from what does not constitute a business. And they said also, apart from these slight changes, the process required to test whether a business exists or not may become cumbersome or complex or onerous to some acquisitions. Therefore, what they have said is that if you don't want to go that route, you can use a quick fix test, which is known as concentration test, to evaluate. And if you go by this way, you use the concentration test to see whether if it is met, therefore it's not a business. If it's not met, it means it's a business. The question then is, what is a concentration test? Now, to do that, I'm going to share this with you from video. Okay. I want Segun to continue from here. We can't hear you. You are muted. Please start all over again.
Okay. How the optional concentration test could save you time assessing whether you have acquired a business. When purchasing an entity or business, acquirers need to assess whether they have acquired assets or whether they have acquired a business in accordance with IFRS 3 business combination. This can be a time-consuming and sometimes complex process. In November 2018, Accounting News November 2018, Accounting News, we discussed changes made to the definition of a business in IFRS 3, which will change this assessment for acquisition occurring on or after 1st January 2020. That is, the changes apply to 30th June 2020, half years and 31st December 2020 year ends for the first time. The amendments were effected in Australian via AASB 2018-6 amendment to Australian Accounting Standards definition of a business. Optional concentration test. In addition to amending the definition of a business, the changes also introduce a optional concentration test, which, if used, could save acquirees a significant amount of time because they will not be required to perform a formal assessment to determine whether an acquired set of activities and assets constitutes a business. In other words, if the criteria in the test are met, this is a shortcut way of concluding that the acquisition is not a business. However, okay, how does the optional concentration test work? The concentration test is optional. Entities may choose to apply or not to apply this simplified assessment process for each acquisition. If the concentration test is met, the acquired set of activities and assets is determined not to be a business. If the test is not met, or if the acquirer elects not to apply the test, then a full assessment needs to be determined to assess whether a business has been acquired or not. Concentration test criteria. IFRS 3 paragraph B7b sets out the criteria for the concentration test to apply. The key driver is the substantially all of the fair value of the gross asset acquired must be concentrated in a single identifiable asset or a group of similar identifiable assets. This is illustrated in diagram below. If substantially all of the fair value of the gross assets acquired concentrated in a single identifiable asset or group of similar identifiable assets. If yes, set of activities and assets. If yes, set of activities and assets not equals to a business. If no, set of activities and assets equals to a business. Judgment is required to determine whether substantially all the fair value is concentrated in a single asset or group of assets. Acquirers will need to apply some additional rules when performing the concentration test. These are set out in IFRS 3 paragraph B7b and summarized below. Gross assets acquired do not include cash and cash equivalents, deferred tax assets, and goodwill arising from the effect of deferred taxation. The fair value of the gross assets acquired includes any consideration transferred, plus the fair value of any non-controlling interest and the fair value of any previously earned interest in excess of the fair value of net identifiable assets acquired. A single identifiable asset must include any asset or group of assets that will be recognized and measured as a single identifiable asset in a business combination. If a tangible asset is attached to and cannot be physically removed and used separately from another tangible asset or from an underlying asset subject to a lease without incurring significant cost or significant diminution in utility or fair value to either assets, for example, land and building, those assets are considered as a single identifiable asset. When assessing whether assets are similar, an entity should consider the nature of each single identifiable asset and the risks associated with managing and creating outputs from the assets, that is, the risk characteristics. The following are not to be considered to be similar assets: a tangible asset and an intangible asset. Can you scroll up, please? Scroll up, sir.
Can you see it?
Yes, you need to scroll up. I finished reading what is on the screen.
I've done that. Okay, let me reshare it. I think it's paused. Can you see it?
Okay, yes. Okay. The following are not to be considered to be similar assets: a tangible asset and an intangible asset. Tangible two tangible assets in different classes, e.g., inventory, manufacturing equipment, and automobiles, unless they are considered a single identifiable asset in accordance with the above. 3. Identifiable intangible assets in different classes, e.g., brand names, licenses, and intangible assets under development. 4. A financial asset and a non-financial asset. 5. Financial assets in different classes, e.g., accounts receivable and investments in equity instruments. And lastly, identifiable assets that are within the same class of assets but have significantly different risk characteristics. Examples where the concentration test may be used. The illustrative example in IFRS 3 demonstrates some examples where the concentration test could be met and the acquisitions accounted for as asset acquisitions rather than business combination. Please scroll up, sir.
Well, that's all.
Okay.
Now, let me show you I'm going to send it to you. It's also part of what you have in your material because I've given every of the standards to you guys. Now, they've given examples which you can study. I'll also share this on your WhatsApp page where you can read it for practical understanding. Okay, but what have we concluded in this is that the work concentration test is only required if you don't want to go through the step-by-step requirement to define what a business is for the entity you have acquired. Okay, now, but if you decide to go through the shortcut, therefore, that is when you do or you take the concentration test. Once the test confirms that there's a concentration in an asset or group of an asset, in that situation, you've met that test and that shows that it's not a business. Otherwise, if you did not meet that test with respect to concentration on an asset or group of assets, in that scenario, we will say it is a business. Now, what is concentration test all about? To say that the fair value of the consideration you offered, is it offered for the purpose of a particular set of assets or group of assets? And if it means that if it covers significant part of that asset, your fair value of the consideration is a significant portion when compared to the acquired asset or concentrated asset, it then implies that such is acquired because of that particular asset in the picture of the acquisition, rather than for the nature of the business. You know, there are strategies to acquiring a business. I'm acquiring a business solely because there's a significant asset in that business that I want to take acquisition of. Not that I have interest in that business. For example, you know, in Nigeria, you have capital gain tax.
Yes, sir.
Now, instead of you buying a particular asset from the owner, you might be subjected to higher capital gain tax plus other transaction taxes like stamp duty, like VAT, and etc. Therefore, what do you decide to do? To buy over the company rather than buying over the assets, which then means that you have no interest in the company, business, or anything. So that once you take over the company, the next thing is that you strip the company off, just subdue the asset by way of acquisition, and that's all. Which is, you are saying that in that regard, can we say it's a business combination? Or what you have acquired, is it a business? The answer is no. Rather, it's an asset acquisition rather than a business acquisition. Does that make sense?
Yes,
now,
sir.
to do that test is to ask yourself that if I pay 100 million naira to acquire a company, and that 100 million naira represents, from my own perspective, 95 million of it is because of this company has a license worth 95 million. It then means that if you are paying 95 million, if you are paying 100 million for a whole business, and 95 million can be attributed to just one asset or group of assets, we are still coming to what we mean by group of assets. It then means that what your intention was that asset, not the business. Which means in that regard, we can consider that you have acquired an asset, which is a purchase of an asset rather than a purchase of a business. Does that make sense?
Yes, sir.
Now, we also said, okay, if it's not a single asset, if it's a group of assets, it must be such that such group of assets have cash flow commonly generated among themselves, which means they are assets that have homogeneous factors and they are assets that are closely related in generating cash flow, such that barely can they generate cash flow independent of one another. And the standard also went further to describe that there are situations whereby there are some things that cannot be similar assets or grouped together. There's no way you can group financial and non-financial assets together. There's no way you can group tangible and intangible together, except in a rare situation where that intangible exists as a result of the existence of all other assets. For example, brand might not exist on its own. You can say now, except if it's acquired. You can say now, and some other things like that. Like you look at asset, like class of assets also is a function. You can't group property, plant, and equipment with inventory because they have nothing homogeneous to relate them together. You can see now. But what the standard is saying that once you have a group of assets or you have an asset in which the purpose of the investment in that company is solely attached to that asset and is considered to be significant to where value is concentrated upon, such will be regarded as asset acquisition rather than business acquisition. I think that speaks volume to what we want to say.
Yes, sir.
I think what I'll do also is to send you, I might copy the links to all of this and share it to you guys. Is that okay?
Yes, sir.
Okay. Any other question? Okay, if there's no question, we'll move further to where we need to start some other discussions. Now we're at the point of discussing contemporaneous and contemporary issues in group accounts. Now, this will take us some time to discuss, and we are going to make some practical illustration to them. The first one is potential voting rights. Have you ever heard of potential voting right before? What is a potential voting right? Asama.
I was about saying I know voting right. I don't know the potential. I don't know what the potential in front of it.
Okay, what is potential in literal meaning?
Say that again, sir.
What do you consider potential in literal or English?
Okay, literally potential could mean something or an event likely to happen. Something of probability. Yeah.
Yeah. Okay. The same thing when you now add it to voting right, it means potential voting right is talking about the right that will add to your power to vote at a later date that presently exists but yet to be unveiled based on certain events in the future. What it simply means is that your voting right that exists today is what we call existing voting rights. Your potential voting right is the additional voting right you can garner based on certain things in the future. And the future we are talking about is immediate future. And let me give you a practical example. You may have 40% voting right today, but you have already entered into a contract with some other shareholders or with the company so that you are to buy additional 15% shares to take you from 40 to 55 based on certain options that has been written or based on certain financial instrument that has been created such that it's only by way of passage of time that such will give rise to existing rights that will now make you have control. What we are now saying is that in assessing whether control exists or not, you don't limit such assessments to current rights or existing voting rights, but you also consider it with respect to potential voting rights in ascertaining whether control exists or not. For example, if I have 45% stake already, and a contract that you enter into such that it's just by way of passage of time within 6 or 1 year or more that is required for such right to be exercised, so that I will now have to buy additional 7% shares to make me a majority shareholder in that case. In that situation, that 7% potential voting right plus my existing voting right of 45%, when we consider it together, it gives me something about 52% that placed me at an advantage of gaining control, which means in assessing whether control exists or not, to some extent, you equally consider not only the existing right, but the potential voting right of the investor. And that's what we are talking about. The other aspect is acquisition-related costs. What are acquisition-related costs? Remember that you don't just decide overnight to acquire a business. In acquiring a business, there are a lot of strategy, lot of legal work, lot of administrative work, and some other things that are involved. And all of these go cost. You incur expenses, no matter how small it is. Now, but those expenses are totally different from your purchase price, which is the consideration you offer to acquiring a business. Now, the question then is, how do we account for those incidental costs attributable to you purchasing a business? How do you do that? How do you account for it in the books of the investor? Already we know how to account for the purchase cost for the business, which is what we discussed even last week. But today now, the other aspect of it, which relates to transaction costs, cost for lawyers, accountants, consultants, registration fees, due diligence. If you are to do share exchange, you have to incur stamp duty, registration of shares with the Corporate Affairs Commission, doing all sorts of varying things. All of these costs, including costs associated with borrowing for financing acquisition. How do we account for these costs in the process of acquiring a business? And that's what we want to look at. IFRS 3 as revised has said acquisition-related costs are not an integral part of cost of business combination, which means they will not be added to the cost of our purchase price of a business, which means they have to be accounted for separately. But the question then is, separately as what? Now we are going to divide it into 3 streams. What are the 3 streams? 1, if these costs are administrative costs, such costs will be expensed directly in profit or loss. I repeat, if these costs are administrative costs, they should be expensed in profit or loss of the investor. The question then is, what are administrative costs? Administrative costs are costs for professional service engagements and any other costs that are more or less to facilitate all what you need to do, other than those attributed to issue of shares or borrowings relating to the acquisition. Any other thing that is not equity related, which is issue of shares, or relating to borrowing through issue of bonds or bank borrowing, are all considered as administrative costs. And all of those costs incidental to acquisition should be expensed in profit or loss. Second one is equity-related costs. Equity-related costs are costs associated to issuing of shares. Example is brokerage cost, issuing house cost, stamp duty for shares issues, registration of shares with CAC. All of these costs are issue of shares related. And these costs should be treated in line with the requirement of IAS 32. The question then is, what is the requirement of IAS 32? IAS 32, as we'll go into it later in the course of this workshop, requires that all incidental costs to issuing of shares should be charged against the proceeds of the issue of shares, which means should be used to reduce equity. But remember, equity has various components. The components of equity that should be charged against should be share premium, if such exists. Otherwise, if there's no share premium, you charge it to any other reserves that more or less could accommodate it based on statutory requirement or otherwise. And if none, you charge it to retain earnings directly, which means such are not expense, neither are they capitalized with the purchase price of a business. Thirdly, if the transaction cost or acquisition cost is related to you borrowing by way of issuing debt, bonds, debenture, or seeking bank borrowing for the sole purpose of acquiring a business, such costs should be used to reduce the proceeds of your borrowing, which will go on in determining your amortized cost and your effective interest rate, which we are going to discuss when we get to IFRS 9. Which means whenever you have acquisition-related costs, you must ensure at all times that such cost is treated in accordance with what we have discussed. Administrative costs should be charged to experts. Equity-related costs should be charged to share premium or other reserves. While debt issuance should be charged to the fair value of the debt instrument in order to obtain its amortized costs as the case moves on. Any other question on that? If I presume that you have understanding of that, what I will do at this point is that I will group you guys. Okay, I won't group you. I want you guys, okay, I'll group you first. And within your group, you guys individually now, after you agree on common ground, you make your own solution and you get back to the house. All of this is that we only give you 15 minutes, 5 minutes each for each question, and 5 minutes for the group discussion before you go into individual question solving. Okay, I'll give you 2 exercises. The first one and the second one, or I'll just give you one. That one will take you 10 minutes because that one addresses the second one also. It's going to be 10 minutes, but you first of all use 5 minutes collectively as a group to agree on the treatment, and you now use the remaining 10 minutes out of 15 minutes to solve it on your own before I will collapse the group and we'll solve the question together. I've sent the question to your WhatsApp group. You can download it there, but I'm also going to display the question on the screen. The question is illustration 4, as you can see on the screen here. I'm sharing my screen with you guys. Can somebody read the question before we go? Mr. Nuruddin, can you read the question before we go into our break session?
Practice question 4, group accounts. PAMI acquired 24 million of the ordinary shares of MAMI on 31st March 2016, when the balances and the later share premium and the retained earnings stood at 40 million and 20 million respectively. The subsidiary was acquired by the combination of cash and share exchange, which has since been accounted for in the parent separate financial statements. Included in the investment amount is the transaction cost of 3 million incurred by PAMI, which comprises 1 million naira from professional fee and due diligence conducted on the acquisition, and additional 2 million as a result of the issue of shares made in exchange for the acquisition of MAMI as at acquisition date. Statement of financial position as at 31st March 2019. MAMI, non-current assets, all figures in millions. PPE, 94 million for PAMI, 50 million for MAMI. Investments in MAMI, 51 million naira. Current assets, inventory, 30 million for PAMI, 12 million for MAMI. Trade receivables, 50 million for PAMI, 18 million for MAMI. Total, 225 for PAMI, 80 million for MAMI. Share capitals and reserve. Ordinary share capital at 50 kobo per share. PAMI 50 million. MAMI 20 million. Share premium. PAMI 82 million. MAMI 40 million. Retained earnings. PAMI 73 million. PAMI deficit 10 million. Total 205 for PAMI, 550 million for MAMI. Current liabilities, trade payables, PAMI 20 million, MAMI 30 million. Total 225, 80 for MAMI. Required, prepared the consolidated statement of financial position as at 31st March 2019.
Okay, the question is clear. Again, the question is in your WhatsApp group so that you can also check it there and download it. Now, our 15 minutes counts now for us to go into the section, and we'll close the section some few minutes to 3 before we come back to the main house. Yeah. The breakout room is open now. Please kindly join. Thank you and effectively participate. Please kindly go to your meeting room, your breakout room. Mr. Shegun and Mrs. Grace. Welcome back from the break session. Okay, we need to attend the lecture together now. What will I do? Okay, I'll cut the question and put it on our working sheet. Okay, let's Pami acquired 24 million shares. That's percentage holdings. He acquired 24 million shares. Out of how many shares? Now look at this. This is the share capital of Mami, and the nominal price is 50 kobo, which means number of shares in Mami will be equal to 20 million naira divided by 50 kobo. And that should be 40 million shares. What percentage is that? I'll pick my calculator. $24 divided by 14 percentages is 60%. Therefore, I can see it to be a group structure. Where I have this structure in place, Pami has 60% stake in Mami. NCI is 40%. When was the date of acquisition? And when was the date of consolidation?
Okay.
Acquisition took place on the 31st of March 2016. And we are consolidating 31st of March 2019. That is exactly 3 years. Let's split the results into pre and post. Results of Mami as at reporting date March 2019 was how much?
20,
The reserve was
20 million.
no negative. No, negative
Negative
10,
10 million, yes.
which means negative 10 million. Which have to be splitted into pre, which is reserved as at 31st March 2016, pre-acquisition. What's our pre-acquisition reserve?
20 million.
We acquired the company when the reserve stood at 20, which is the retained what? Earnings. Now the retained earnings was 20, positive. Now what is our post-acquisition? Remember you made 20 and you took it to a loss of 10. What has happened within a space of 3 years?
Loss of 30.
Loss of what? 30 million loss. Okay. Now, but when we look at our share premium remained the same at 40 million, which is the same thing as this 40 million. Therefore, there's no issue of pre and post in that. Okay, that is that. Now, but before we carry out our cancellation, what do we need to do? Before we carry out our cancellation, we need to check the treatment accorded acquisition related costs. In the course of this acquisition, we had acquisition related costs, which total $3 million. Now, this 3 million was broken down to 1 million naira professional fees and additional 2 million as a result of issue of what? Shares. The question then is, has it been treated? If no, we treat it accordingly. But if yes, which means it has been treated, how was it treated? Is it in accordance with the requirement of the standard? In this question, it has been treated, and it was treated as part of cost of acquisition, which means the 3 million was included in this 51. Is this correct?
No.
The answer is what? No. Can you remind us why it is no?
It is no because acquisition costs should not be parts. I mean, other costs relating to acquisition, like administrative cost, professional cost, and cost of issuing shares and debt should not be included in the investment in subsidiary, in the cost of investment in subsidiary.
Okay, thank you very much. If that is the case, let us pick it one by one. The professional fee of 1 million naira and the issue cost relating to share exchange in the course of the business combination have been in the business combination. I think I skipped that. have been erroneously or wrongly treated. Hence, they demand corrections. Now, what are the corrections? What are the corrections? One, professional fees should have been expensed. Is that correct?
Yes.
Therefore, what entity do we pass? Is to debit the expense, and the expense affect the profit or what? Or loss of the parent who invested, pardon me? And the credit is to negate the impact by removing it from cost of business combination, which is the investment value, and bringing it here, which means you will now credit Pami's investment, where the item was erroneously put in what? In Suzy. How much? 1 million. By the time we do this, you find out that that 51 million will become 50 million. But we have not finished.
That's mommy, not Susie, sir. Credit.
Oh, sorry. Where did Susie come from? Okay, because Susie has always been our example, Abby. Thank you. Second one, which is the second error, is that the share exchange issue cost.
You still wrong. You still wrote Susie, sir.
Are you sure I've written?
Yeah, okay.
I think I've not eaten, that's why. Thank you. Now, issue cost on shares exchange should be what? Should be charged to share what? Premium. And if we don't have share premium, we'll have charged it to retain earnings or any other appropriate reserve for that purpose. Share premium. Therefore, we debit share premium of who? Of Pami, the investor, and we credit Pami's investment in what? In Mami. How much? 2 million, not 3 million. Now, this has addressed it, such that for the purpose of our cancellation, Pami's investments in Mami as revised or updated all in millions will have been initial amount of investment as reported in the account, which is 51, less those corrections made, professional fee erroneously added, 1, and issue cost, issue share cost of 2. And that gave me a correct amount of 49 instead of 51. Group 1 and 2, did you arrive at this position before you proceeded in consolidation?
It should be 48.
Okay, 49. Is it 49 or 48?
48, sir.
48.
Thank you.
Yes.
Okay. Therefore, we can proceed to consolidation. Let us determine whether there's goodwill, cost of business combination, Pami's investment in Mami is now 48, now 51. NCI is measured 40% of the net asset which you have not obtained. What is the value of the net asset acquired? Mami, as at the date of what? Acquisition. Share capital. Of Mami. Share premium. Of Mami. And pre-acquisition reserves of Mami. Now let's check them one by one. I didn't save it, sorry. I'll have to repeat it. Okay, what's the share capital of Mami? 20, share premium 40, and pre-acquisition reserve is positive 20. And I think this is 80. Okay, let's check again. 20, 40, 20, okay? Now, what is 40% of 80? That's 32. This gives me 80. 80 cancel 80, it means there's no goodwill. Now, what's my consolidated reserve? as at 31st March 2019. Consolidated retained earnings and NCI. All figure in millions. What is PAMI's retained earnings? PAMI's retained earnings is 73. What is NCI as valued as at the date of acquisition? It is 32. What is common to NCI and the parent is the share of post-acquisition loss, 30 million loss. We share it ratio 60 to 40. That's 60 is 18, 40 is 12. Now let's pick the adjustment that affected retained earnings. Here, you are told to reduce the profit of PAMI for the expense relating to professional fees. Therefore, I'll come here, less professional fee on business combination. That is one. The other one affects share premium. When we get to balance sheet, we'll treat that. No impairment loss, no goodwill, nothing. Therefore, I can sum it up here and say, this is 20 and 73 minus 18 minus 1. That's 54. Now let me see share premium now. Share premium of PAMI revised. It is what we have in the account as per account. What was the share premium in the account? 82. Less what we have here, a charge for the share premium on issue cost on share exchange. Less issue cost. Of 2. Therefore, this is what? 80. All things being equal, what's our balance sheet? Let me go ahead and copy one of those balance sheets we have. Okay, so let me copy this. This doesn't have copy. Okay. Let me clean it up. Okay. This PAMI, March 2019. Okay, what's our property, plant, and equipment? Let me try and put it side by side. That's 94 and 50. That should give me 144. Goodwill does not exist, is 0, which need not to be shown. Current assets. Okay, my current asset is broken down. Therefore, I have to break this down. Current assets. I have inventories. And I have trade receivables. What is my inventory? 30 and 12. That's 42. What is my trade receivables? 50 and 18. That's 68. This should give me 110. All in all, I have 254. Share capital is for PAMI. What is the share capital of PAMI? 50. What is our consolidated retained earnings? That's 54. That should give me 104, which is the equity of PAMI. NCI is 20. That gives me 124 total equity. Okay, the share premium we missed out because it's not in this before. Okay, what should I do? Let me cut it and break it down. Okay. All right. Let me clean this up. equity and liabilities, share capital and reserves, share capital, PALI, sorry, that's PAMI, share premium, PAMI, and retain earnings, consolidated, which we said was 54. Share capital was 50. While share premium was 82, but after our adjustment here, it becomes 80. I will take it revised so I can check it. Okay. Therefore, our total has changed. This is 104, this 184. You can confirm from your own calculator. This is 204. Now, what's our liability? We have trade payable, 20 and 30. 20 and 30, which is 50. That gives us 254. Any other question? Did any of us got this right?
Yes, I did. I got it right.
Okay. Who else?
I got it almost right, but I just made some few posting errors.
Okay. Thank you. Any other question on that?
Okay, let me just answer this question. So these adjustments, they are to be made on the consolidated
not on the
balance sheet.
Not on the consolidated. On the financial statement of the financial statement of the parent. It's the parent that has made a mistake in his financial statement, which means the correction is on the financial statement of parent before consolidation. That's why when you see the entries I passed, the entries were emphasizing parent investment in MAMI, profit or loss of MAMI, share premium of MAMI, you understand? Because it didn't account appropriately in its own separate financial statement prior to consolidation. Did you get that, sir? No?
Yes, I do. But many other adjustments are actually done on consolidation anyway. So the parent one is quite different, like all this goodwill gain.
We are not at that. We are not at that level. Let's try to understand something. This is a process of learning and it takes time. You understand? It's a process. We are not talking of any other adjustment here. We are talking specifically on acquisition related costs. You understand? When we get to every bridge, we try to cross that bridge.
Okay.
You understand? We are not even talking of group adjustment now. If you ask me, is there group adjustment? I'll tell you, I don't even know what it is for now. You understand? When we get there, we'll probably cross the bridge. Any other question? Okay. Let's continue our discussion. You know, we've discussed potential voting rights. Now we have discussed acquisition-related cost treatment. Next is for us to discuss on asset held for sale. Remember, we said before 2008, when you have a subsidiary that you hold for the purpose of selling or for temporary reason, which qualify under IFRS 5, non-current asset held for sale. Before now, we say on that premise, we do not consolidate. But based on the revision to the standard IFRS 10, we said going forward, you still go ahead to consolidate, even when such is held for a temporary reason. And which that means that what we need to do is that upon consolidation, we'll still consolidate the asset and liabilities, but we are going to consolidate it below the line where we'll disclose it, where we disclose non-current asset held for sale. Okay, remember, okay, probably we've not discussed that. When we get to IFRS 5, we'll get to a level where we show how we disclose in the balance sheet non-current assets and non-current liabilities that are held in relation to selling off in the immediate period, which will not be more than 12 months from the reporting date. And that's what standard says, which means we still go ahead to consolidate. Okay, when we get to IFRS 5, we'll come back to this position for you to have a better appreciation of it. Next one is reporting date. It is expected that when you are consolidating financial statement of parent and subsidiary that has the same reporting date. But the question is, it is expected, but is it a must? The answer is no. It's not a must for the parent and subsidiary to have reporting dates to be the same, but it is much more preferable for them to have the same reporting date. But the question then is, if they don't have reporting dates, what happens? Provided the difference in their reporting date is not more than 3 months, you can still proceed in consolidating them based on different reporting dates, subject to material adjustment for transactions that will have occurred between the reporting date of the earlier one to the reporting date of the later one. Let me break it down. If the parent reporting date is every 31st December and the reporting date of subsidiary is every 30th September, for financial statement ended 2020 December for the parent is to consolidate the subsidiary ended 30th September 2020. We will go ahead to consolidate and we adjust for material transactions that have occurred between those dates, provided it's not more than 3 months. But if it's more than 3 months, what then do you do? What you do in that regard is that you need to reconstruct the financial statement of the subsidiary in such a manner that it will align with the reporting date of the parent. Let me give you an example. Subsidiary reporting date is every 30th of June. The reporting date for the parent is every 31st of December. This means that the difference between them is 6 months. Therefore, 6 month account cannot be consolidated with 1 year account in that regard. Therefore, what do? What you do is that you will have to construct financial statement of subsidiary in a manner that will show 12 months running from January 2020 to December 2020. How do you do that? Remember, for the subsidiaries account to run to June every year, it means you will have started July of the preceding year, which means it has financial statement that run from 1st of July 2019 to 30th of June 2020. And likewise, you will have commenced another financial statement running from 1st of July 2020, which is expected to run to June 2021. But we are at December 2020, which means it will have only run for 6 months. That 6 months plus 6 months of last year Last year was July 1st to 30th June, which means you will now have to cut off 6 months from last year, which means 6 months from last year means from January 1st, 2020 to 30th June 2020 for the subsidiary. You now add it to activities that has occurred between 1st of July 2020 to 30th of December 2020, so that you now reconstruct a 12-month account which can now be consolidated with that of the periods. And that's what the standard signifies. Any question on that?
Hello, that reconstruct, I didn't get it. You are going to use 1st of July 2019 to 30th June 2020. I think, is that what you are trying to say? Reconstruct. I didn't get that point very well.
Okay, what I'll do for you is to open a whiteboard and show you what I meant. Reconstructing subsidiaries accounts. For the purpose of consolidation, where difference in reporting dates is more than 3 months. Scenario: parent has its accounting period to be 1st of January 2020 to 31st of December 2020. Subsidiary as its accounting period run from 1st of July 19 to 30th of June 2020. For you to have another financial statement, it will be next year by June 2021. Okay? Now, parent is to present group accounts for the year ended 31st December 2020. The question then is, what should we do? Mr. Naro, what should we do? What should we do, sir?
You were trying to tell us what to do.
I've explained what we need to do from the standard. Therefore, or just think it through. What will you do in this situation, sir? Since it's more than 3 months.
No, you explained it, but I didn't get that explanation. But for me, I don't know what the standard actually says, but you can't do 6 months plus 1 year. So you probably take the 1 year of subsidiary and 1 year of.
Okay, tell me, if there's no accounting standard, what would be the best thing you would decide to do from your own understanding of your experience in accounting, what will you do that you believe is more preferable?
Well, for me, there are two ways you can do it. One, you can take from 1st of July 2019 to 30th of June 2020 and consolidate with that of parent for the year of 2020.
Therefore, you are consolidating 12 months that ended June to 12 months that ended December.
December, that was one option. The other option is that you take that of the subsidiary for 6 months of 2020, January to June 2020. Then you can now increase it by 2.
I mean, multiply by 2.
Yes, which will look dubious.
Whether you make such or not. Is that accounting or what?
That would be dubious. So basically, I just say my own. I don't understand any other thing again.
None of what you said is going to be considered at all. Because one, the first one you said is odd in the sense that you are picking totally different years and totally different years, putting together and reporting. What will you then be communicating? What meaning will our shareholders make from it or our stakeholders? And second one, when you have report of 6 months and you double it, does that mean that you are guaranteed that they will make the same amount of revenue, asset, and all sorts of things? Therefore, what the standard says is so clear. If it's 3 months, this problem will not have arisen. We'll go ahead to consolidate and adjust for material differences. But what we are saying is this. The parent financial statement runs from beginning of the year is 1st of January 2019, and this will run from year to year, which is the end of the year, 31st of December 2019. 2019. Let me pick 20. Okay, it's 2020. We picked 2020. Now the subsidiary. The subsidiary runs from 1st of July 2019 which ends somewhere here, 30th of June 2020. Okay, now if the subsidiary is to run another year, it will run from here to here, which is end of year 2. This is end of year 1, which will be 30th of June 2021. Now, what we are saying is that the parent is presenting account in this period. Now, to prepare the group account, group account is prepared in line with the parent's account policies and everything, which then means that the date of the parent is what we consider for the group, because the parent represents the group, like your family name, your surname represents the family, which means it's not your own name. Therefore, what we'll do is that we'll look at it that this period is what we need, which is the beginning year for the group also. And we also pick the end year, which is the end of the year for the group also. Now, if you look at it, what did you see? You find out that you have 6 months here, out of the 12 months here. And you have this year that has not ended because This year has not ended. I'll use broken line to show that it's still a year that is running. Okay. Now, when you check it like this, you find out that this is another 12 months. This is another 12 months, of which 6 months has ended. But the whole full year has not ended because of his own accounting year differ. Therefore, we also pick from here. When you add 6 plus 6, half from this year, another half from this year, will give us 12 months that we can merge with this 12 months and produce group accounts for this period. Does it make sense to you now, sir?
Yes, I do. It does. It does. It does. Like in practice, practicality of it it's not that easy anyway. It incurs a lot of cost, but it is okay. Understand that.
The argument is this: you barely see this in practice. Who can tell me why? Who can tell me why we not see this in practice in its real sense?
In practice, I feel that it is not very practicable to do it. It will cost. It's costly.
If it's costly and you must do it, what then do you do, sir? In practice,
maybe you do half year financial. You do half year.
Is it not the same thing as you do if you do half year? In time account. What we are saying simply is that
okay.
Okay.
I think in practice, since we still have 6 months windows before we can file our accounts, I think by then the subsidiary might have completed like 9 months, which will make the subsidiary accounts to be consolidated with the group.
No. You are missing it up. We have no issue with the subsidiaries account too. We are saying that the reporting date is 6 months apart. Nothing is changing anything. The reporting date is 6 months apart. Now, let me give you the simple answer. The simple answer is that if you truly have control, you should be able to influence the reporting date of the subsidiary so that it doesn't get to this level. That's what they are simply telling you. But let us even say you have control, but there are regulatory issues. For example, in Nigeria, whether your parents like it or not, if you are a financial institution, like banks, your reporting date must, not should, must be 31st December. That is CBN rule. Which means there's no amount of control your parent can exert that will change that date. Which means, in reality, what the parent should do is to also align with that date, if practicable. But again, what if your parent is a foreign company that also has regulation that says every June in its own country? There's nothing you can do. Therefore, which means you have to incur such cost of reconstructing accounts for the sole purpose of consolidation at every reporting date. Does that answer the question, man?
Yes, it does.
Okay. Uniform accounting policies. Again, it is expected that the accounting policy of the parent and the subsidiary should be the same. But when they are not the same, before you consolidate, you must adjust for the accounting policy of the group. What it simply means is that first, usually accounting policy of the group is the accounting policy of the parent or vice versa. Which then means that if the subsidiary accounting policy is not in tandem with that of the parents, before you consolidate, you identify where are the differences in accounting policy. For example, the group accounting policy is to carry PPE at cost, but the subsidiary policy is to carry it at a valued amount. At every consolidation date, any evaluation that has been done have to be reversed before you consolidate. And that's what we are saying, which means at every point in time, any differences in the accounting policy of the parent and the subsidiary's account have to be adjusted to align with that of the parent before consolidation takes place, because it is presumed that the accounting policy of the group is represented by the parent's accounting policy. Does that make sense?
Yes, sir.
Now, the next thing is date of inclusion and exclusion. Date of inclusion means when did you start to combine the result of the subsidiary with that of the parent? And that point is from the date the subsidiary has been acquired by the parent. And the date the subsidiary is acquired by the parent is otherwise known as the date of acquisition, which is the first date to which the investor or the parent obtains control of the investee of the subsidiary. The date of exclusion is the date you cease to consolidate the result of its subsidiary. And that date is the date in which control of the subsidiary is lost by the parents. Okay. I want Nudi to read attribution of losses from a subsidiary.
Okay. Attribution of losses. Based on the provision of IFRS 10, non-controlling interest can be negative. Okay, non-controlling interest can be negative by absorbing losses in excess of its shares of the net asset in the subsidiary. This is consistent with the idea that non-controlling interests are considered investors of a separate class in the group, whereas in the previous IAS 27, before its revision in 28 and subsequent replacement by IFRS 10, non-controlling interest could not be negative, as losses exceeding non-controlling interests were attributed to the parent and absorbed accordingly. An entity shall attribute the profit or loss and each component of other comprehensive income to the owners of the parent and to the non-controlling interests. The entity shall also attribute total comprehensive income to the owners of the parent and to the non-controlling interest, even if this results in the non-controlling interest having a deficit balance.
Now, what we are saying is this. Before now, non-controlling interest is strictly equity attributable to equity attributable to others other than the controlling what? Interest. Okay, then the standard before its revision prohibits the situation where non-controlling interest can be negative, which means non-controlling interest before now, no matter the amount of losses that a subsidiary can have, before now, non-controlling interest can only be eroded to a level of zero. But revision to standard and also the definition of equity has shown that it is the residual interest, which can be negative. Therefore, what it simply means is that non-controlling interest can become negative equity. What it simply means is that you, as a non-controlling interest holder, and I am the controlling interest holder, you have 20%. The 20% upon acquisition was worth 10 million naira. And since acquisition today, the company has continued to make losses such that your share of loss has eroded your entire investment. And the question then is, your investment is now reading negative investment, which means you are like indebted. The question then is, can non-controlling interest be negative? The position of the standard is yes, because equity can be negative, which means non-controlling interest will be negative to the extent of the share of losses that has been attributed to it from the subsidiary. You can say now, and that is the position of the standard. Which means if you find yourself in a situation where you can put NCI and it's negative, don't be scared. You will still show it within equity and you put it as negative instead of positive. Negative means that it will reduce your total equity. The same way your retained earnings can be negative and it becomes accumulated losses. You won't take it to asset side as positive. You still maintain it within equity because what it's saying is that it's eroding your equity as a whole. Does that make sense?
Yes, sir. Please, can you just say this again? You said to the extent that the NCI can be negative to a certain extent. So I want to.
No, I'm saying that before now, NCI will never be negative.
No, that's not what I'm asking. You already explained that NCI can be negative, but to a certain extent of the loss attributed to it or something. That is what I want to get again.
Okay, now what we are saying is this. NCI can be as negative as anything. It doesn't have a limitation.
Okay.
I get it now.
Yes,
now, what I have used the phrase extent to is that if NCI is negative and subsequently the subsidiary has now started to improve in its performance and is now making profits, you understand? You are going to first of all ensure that the losses are first of all erased before NCI can become positive.
Yes.
I get what I'm saying now.
Yes, sir.
And that's the position of the standard.
Okay.
Okay. These other ones, we have discussed it. Accounting for subsidiary, joint venture, associate, independent, separate financial statement. We have discussed that last week. And we have discussed NCI, the two methodologies, proportionate share and the fair value. Okay. Gain or bargain purchase, we have discussed it. Contingent consideration, we have discussed it. Okay. IFRS 3 and fair value of subsidiaries net asset. We'll be discussing that, I think, tomorrow. I think we are getting to that level tomorrow. If not tomorrow, in the next session. Okay, that is a whole chapter of its own. I think that is chapter 7. That's a whole chapter 7. Okay. After today, I will advise you to, okay, before chapter 7, you look at chapter 6, but that is that. Okay, where do I stop? Okay, can you read restructuring and future costs?
Okay, restructuring and future costs. Liabilities for future losses or other costs expected to be incurred as a result of business combination should not be recognized by the acquirer. IFRS 3 explains that plan to restructure a subsidiary subsequent to its acquisition is not a present obligation of the acquiree at the acquisition date. Neither does it meet the definition of a contingent liability. Invariably, an acquirer should not recognize the liability for such a restructuring plan as part of allocating the cost of the combination, unless the subsidiary was already committed to the plan before the acquisition.
Now, this is in line with the requirement of IS 37. Okay, When acquisition is to take place, there will be plan to restructure, and sometimes in an acquisition, it's expected that in the first few months or years, there will be losses expected because of reorganization and some other things. Therefore, what the standard is saying is that should we take that into consideration in acquisition date accounting? The answer is no. Okay, you don't take that because these are not onerous. Neither do they meet the definition of a liability that talks about present obligation. And such should never be taken into consideration. Okay, except if there's a commitment, such commitment has gotten to a high level, which has been taken by the former owners of the subsidiary prior to the acquisition. That's only when it meets the definition of a liability or provision that need to be taken into consideration. Okay, when we get to IS 37, we'll discuss that further. Indemnification assets. Okay, can you read it, Shegun?
Indemnification assets. The seller in a business combination may contractually indemnify the acquirer for the outcome of a contingency or uncertainty related to all parts of a specific asset or liability. For example, the seller may indemnify the acquirer against losses above a specified amount on a liability arising from a particular contingency. In other words, the seller will guarantee that the acquirer's liability will not exceed a specified amount. As a result, the acquirer obtains an indemnification asset. The acquirer shall recognize an indemnification asset at the same time that it recognizes the indemnified item measured on the same basis as the indemnified item, subject to the need for a valuation allowance for uncollectible amounts. Therefore, if the indemnification relates to an asset or a liability that is recognized at the acquisition date and measured at its acquisition date fair value, the acquirer shall recognize the indemnification asset at the acquisition date measured at its acquisition date fair value. For an indemnification asset measured at fair value, the effects of uncertainty about future cash flows because of collectibility considerations are included in the fair value measurement, and a separate valuation allowance may be necessary. Technical notes. At the end of each subsequent reporting period, the acquirer shall measure an indemnification asset that was recognized at the acquisition date on the same basis as the indemnified liability or asset, subject to any contractual limitations on its amount, and for an indemnification asset that is not subsequently measured at its fair value, management's assessment of the collectability of the indemnification asset. The acquirer shall derecognize the indemnification asset only when it collects the asset, sells it, or otherwise loses the rights to it. This is the right.
Now, what is an indemnification asset? Who can explain from practical experience with practical illustration? Have you heard of it when a company wants to acquire another company? There's always an indemnification clause. What does that clause mean? And what does that create? What does it tend to salvage? What protection is it serving?
Okay, I want to give it a try.
Okay, sir.
Though I don't have the practical experience, but from the word indemnify, and that is to reimburse or to make good to somebody for certain losses or experience that the person had. So, for instance, if I'm in a contract with you and maybe I breach the contract and you suffer loss as a result, and we have to indemnify you for the losses that you have suffered. So, in the same vein, when when a company acquires a subsidiary and there are certain contractual agreements that, for instance, this asset should be able to generate certain amount of income for you over a specified number of years. And it turns out that that did not happen. And there's a clause in the contract, in the acquisition contract, that if this asset did not fulfill the obligation, or you did not get the benefits from it, I will indemnify the former owners of the subsidiary will indemnify the new parent to a certain amount. So if that if that is not met, or that asset does not provide the necessary economic benefit, then the previous parents of the subsidiary are bound to indemnify the new parent of the subsidiary. So that is my explanation.
Thank you. You got it right. And that's one aspect. I want us to look at this, and from there, there's another aspect that somebody has mentioned today, and there are more aspects in which people can still mention, but I'll share this with you first, and I want you to read it, please. Indemnification assets. Okay, Shegun, can you read this?
Okay, sir. Indemnification assets means any indemnification rights or claim of the acquired companies or related consolidated entities recognized as a current asset under the accounting principles, and which represents a claim of seller or any of the acquired companies or related consolidated entities against the third parties, but solely to the extent corresponding to obligations that have been included in the pre-acquisition and litigation liabilities.
Now, let me practicalize it in addition to what you're going to say. For example, when you acquire a business is a continuum where every historical liability of the business becomes the liability of the new buyer. You are not buying assets one by one. You bought that business, which means you bought that business with its assets and liabilities and unidentified liabilities. That's why that clause is always there, because you would have done your due diligence, and due diligence would have shown all liability possible. But again, there are some hidden liabilities that due diligence may not show, or there might be some things that are inherent which may surface tomorrow by way of contingent liability. Therefore, what do? You put a clause there that I'm buying this business at this value based on utmost good faith, based on the fact that this is what I know about it and this is what has been presented to me. But because I know by company law, whether new business, new owners or not, you assume liability immediately you take over of anything that has happened in the past. Therefore, peradventure anything come up which is not part of what is known to us today, and I'm liable to pay for it, you must indemnify me. Example of that is if they come to do tax audit. You know, the tax assessment you have shown shows this, there's no issue. I've even paid all my taxes. But remember, your tax is not final and conclusive until audit has been done and everything closed out. Therefore, if 2 years down the line, they came for 6 years audit before it become status quo bar, any liability coming from it should not have been my own liability, which then means that if I don't have such indemnity clause, I'll be the one to suffer for it, while the former owner has zoom off. Am I making sense? Therefore, what we are now saying in this regard is that such indemnification clause creates indemnification right, which is an asset. Okay, but how do we recognize that asset? If the liability has not been recognized because it's still contingent, such asset cannot be recognized. But if the liability has been recognized because it has become present, or it can be fairly measured, therefore you also recognize the indemnification assets using the same methodology of fair value. But the additional issue regarding the indemnification asset is that because it's an asset, the chance of recovering it in full may be limited, and therefore there is an allowance that might be created for non-recoverability in full. You know, liability is difficult to throw away, but your own asset is difficult to recover in full. That is the nature of a business. Do you get what I'm saying now? And in that situation, apart from recognizing it as fair value alongside with the liability that has been recognized, you must also, at every reporting date, review such assets for its recoverability position or test. Does that make sense now, sir?
So,
okay. Now, intangible assets, we've discussed it when we are talking of goodwill in one light or the other. But when you get to IAS 38, we'll discuss it extensively. Okay? But again, remember, intangible assets that more or less we consider with respect to business combination are intangible assets that won't have been recognized on the standalone basis, such as customers list, such as goodwill, but they are recognized in this case because they were acquired. They are not inherent, neither are they internally generated. Okay, that is what we are talking about here. Goodwill and impairment, we have discussed that extensively. Now, I want someone to read measurement period and let me explain the issue of measurement period and how it affects the measurement of goodwill subsequent to acquisition. Okay, measurement period.
Okay, measurement period.
Okay, I'm coming. Continue.
Measurement period. If the initial accounting for a business combination is incomplete by the end of the reporting period in which the combination occurs, the acquirer shall report in its financial statements provisional amount for the items for which the accounting is incomplete. During the measurement period, the acquirer shall retrospectively adjust the provisional amounts recognized at the acquisition date to reflect new information obtained about facts and circumstances that existed as of the acquisition date and, if known, would have affected the measurement of the amount recognized as of that date. During the measurement period, the acquirer shall also recognize additional assets or liabilities if new information is obtained about facts and circumstances that existed as of the acquisition date and, if known, will have resulted in the recognition of those assets and liabilities as of that date. The measurement period ends as soon as the acquirer receives the information it was. Stroll up.
Yeah.
It was seeking from facts and circumstances that existed of the acquisition date of
Did you see it?
yes.
Can't you see it?
Is covering.
How is it covering? Is it covering for others too? It's not covering for, yeah?
It's covering from me, it's from me.
no, sir, it's not.
Okay, Sheku, can you continue from that?
Okay. Seeking from facts and circumstances that existed as of the acquisition dates or learns that more information is not obtainable. However, the measurement period shall not exceed 1 year from the acquisition date. Technical notes. The measurement period is the period after the acquisition date during which the acquirer may adjust the provisional amounts recognized for a business combination. The measurement period provides the acquirer with a reasonable time to obtain the information necessary to identify and measure the following as of the acquisition date in accordance with the requirements of IFRS 3. The identifiable assets acquired, liabilities assumed, and any non-controlling interest in the acquiree, the consideration transferred for the acquiree, or the other amounts used in measuring goodwill. In a business combination, achieved in stages, the equity interest in the acquiree previously held by the acquirer, and lastly, the resulting goodwill or gain on bargain purchase.
Okay, now what we are saying here is this. Measurement period is a period of not more than 12 months. And it's a period of not more than 12 months where allowance is given for you to go back and recompute the amount of your goodwill, given that you now have sufficient information to confirm what was existing as at acquisition date. And this is because as at acquisition date, you have not had the full-fledged information of what it is. And this is common when you acquire a business that is not well organized, or you acquire a business from a public sector or from government, where things are not that transparent or well kept. For example, I'll look at Nigerian concept. Anytime government do privatization, no amount of due diligence you will do until you get in before you can know the fact.
Exactly.
Because due diligence is based on human being and information you are given access to. How many times have you seen where even in US, when Joe Biden came in, he had to make some amendment to say, we didn't have this information because Trump did not do normal handing over so that we don't know that it's up to this debt. And therefore, we have to now readjust our timetable because we are now seeing it the way it is. Look at Nigerian concepts. Imagine when they sold NEPA. There's no amount of due diligence you will do in this world that you get anything until you sit down. Even when you sit down on ground, 1 year might not be sufficient for you to see all of the pictures of what exists and what does not exist, at what value they exist, what are your encumbrances and other things. Now, what happened there is that in that situation, the standard says such process is not complete. Therefore, they now give you 12 months in which you have started to hold control and you are now involved. Therefore, 12 months is enough for you to have exhumed all what you need to exhume in order to ascertain what existed 12 months backward. And during this period, anything you do or you discover there is discovered as a new information but existed as at acquisition date, which means it's going to be treated as a pre-acquisition adjustment, which eventually affects your fair value of the identifiable net asset that was acquired as a date of acquisition. Invariably, that will affect the amount of any goodwill or gain that arose from a bargain purchase transaction. Does that make sense?
Yes, sir.
And that's what we are talking about. But the allowance is only given for 12 months. Anything above that 12 months will result into a post-combination. Therefore, you can't go back and adjust your goodwill. That 12 months is sufficient enough. And I think it's reasonable. Even though they've not seen or test the water in Nigeria that even in 5 years, it might still be exhuming as much as possible. But again, that is the situation of things. Does that make sense, please? Okay, reacquired rights. I want somebody to read reacquired rights.
Okay, reacquired rights. The acquirer shall measure the value of a reacquired right recognized as an intangible asset on the basis of the remaining contractual term of the related contract, regardless of whether market participants would consider potential contractual renewals when measuring its fair value. Technical note: a reacquired right recognized as an intangible asset shall be amortized over the remaining contractual period of the contract in which the right was granted. An acquirer that subsequently sells the reacquired right to a third party shall include the carrying amount of the intangible asset in determining the gain or loss on the sale.
That's very simple. When you acquire the right, it has a value. And such a value, how do you treat it? You treat it as an intangible asset that has to be amortized over the remaining life of that right. Okay. Okay. Reverse acquisition. This is very germane, and I'm going to explain it with practical examples. Okay, what is a reverse acquisition? What we know is acquisition. When does acquisition become reversed? Okay. Second, can go ahead.
Okay, IFRS 3 also addresses a certain type of acquisition known as a reverse acquisition or takeover. This occurs when a company, hypothetically called Success PLC, acquires ownership of another company, hypothetically called Dynamic Limited, through a share exchange. For example, a private entity may arrange to have itself acquired by a smaller public entity as a means of obtaining a stock exchange listing. The number of shares issued by Success PLC as consideration to the shareholders of Dynamic Limited is so great that control of the combined entity after the transaction is with the shareholders of Dynamic Limited. In legal terms, Success PLC may be regarded as a parent or controlling entity, but IFRS 3 states that as it is Dynamic Limited shareholders who control the combined entity, Dynamic Limited should be treated as the acquirer. Dynamic Limited should apply the acquisition or full consolidation method to the assets and liabilities of Success PLC. Furthermore, reverse acquisitions sometimes occur when a private operating entity wants to become a public entity but do not want to register in its equity but not want to register its equity shares. To accomplish that, the private entity will arrange for a public entity to acquire its equity interest in exchange for the equity interest of the public entity. In this example, the public entity is the legal acquirer because it issued its equity interest, and the private entity is the legal acquiree because its equity interests were acquired. However, application of the guidelines of the standard IFRS 3 results in identifying, please scroll up, sir. Results in identifying A, the public entity as the acquiree for accounting purposes, the accounting acquiree, and B, the private entity as the acquirer for accounting purposes, the accounting acquirer. Technical notes, the accounting acquiree must meet the definition of a business for the transaction to be accounted for as a reverse acquisition. And all of the recognition and measurement principles in IFRS 3 should IFRS 3, including the requirement to recognize goodwill, apply.
Now I will explain it further. Reverse acquisition only comes by way of strategy. And the common way to which such strategy is used is this. First, listing of a company is not a day's job, and it's not a baby's job. There are conditions, very stringent, for you to get yourself listed. Do you know why? Because you are coming to the public to raise funds. And the public are always seems to be vulnerable. Therefore, if not, everybody, I can even start a company tomorrow with the intention to do something or to defraud, and in 6 months' time I listed, I collect public fund, I run it aground, everybody lose, I move. Do you get what I'm saying now? Listing is so stringent. Sometimes listing is such that, especially if you're a foreign investor, you might find it much more difficult. Therefore, what do? You look for a smaller company that is already listed, or a company that is struggling, even who is begging for survival. And what do? You enter into a scheme of arrangements, such as acquisition, with the hope that you will use your company to, you will do it in such a way that that company will acquire your company. And that strategy can only be executed through share exchange. Such that when that company in the capital market, which is struggling or small company, will acquire you with share exchange, so that by the time they exchange shares, because you are more valuable than that company, the end product of that acquisition is that you will be having more of the shares of the listed entity than the listed entity having your own shares. Eventually, you now be unveiled as the new majority shareholder of the listed company, which means invariably you now merge the two companies together and unveil yourself as the reality, which you have beat the law. Do you get what I'm saying? Which means today, if I want to get Fiponomics, Green Finance, Professional Services listed in the capital market, such strategy is what I can use, that by tomorrow, I become a PLC. So that I look for one small PLC in the market. We enter an agreement that, okay, let us do an acquisition where you acquire my shares in exchange for your shares. Because my share worth 1 billion, their own shares worth 100 million. By the time we exchange it, you find out that I'm the majority shareholder of the combined business invariably. At that time, I've taken control. I'll now say I'm merging the two companies together. Before you know, that company that you call ABC PLC will now become Fiponomics Green Finance PLC. And that is all. It's a strategy. Okay, the question then is, how do we account for it? In this strategy, you now find out that the legal acquirer is not the accounting acquirer. Before now, the legal acquirer and the accounting acquirer are the same. But in this case, the legal acquirer is the small company that acquired the big company. That is a capital market company. But the accounting acquirer is the one that has the substance, the one that control is with. And is the one that has the majority shares. Whereas the legal acquiree, which is me, will now become the accounting acquirer. Why the legal acquirer will now become the accounting acquiree. And from IFRS, financial reporting is IFRS based, which is substance over form. It is you, the accounting acquirer, who control reside with, regardless of the legal structure that is to consolidate. Am I making sense? Now, let me show you examples. You can go and study it further. One example of a reverse merger was when ICIC merged with its arm, ICIC Bank, in 2002. The parent company balance sheet was more than 3 times the size of the subsidiary at that time. The rationale for reverse merger was to create a universal bank that will lend to both industry and retail borrowers. But let me show you another one that is critical. Okay, let's read this. Can you read this up now? What a reverse takeover and how does it work?
Okay, what is a reverse takeover and how does it work? A reverse takeover enables a private company to go public without the attached cost and time delay of an initial public offering, IPO. Find out more about reverse takeover, how they work, and how you can trade them. What is a reverse takeover? A reverse takeover, also called a reverse merger or a reverse initial public offering, enables a private company to be listed on the markets without having to organize and pay for an IPO. Reverse takeover occurs when a private firm takes over a public firm that no longer has an active operations. How does a reverse takeover work? A reverse takeover works by a private company merging with a public company. The publicly listed company is often a shell corporation, meaning that it is inactive or holds very few assets. It may no longer have any operations of its own, which enables the private company to buy up the publicly listed company's share. The private company, along with the shareholders, we buy enough shares in the shell company to give it majority control over the public company. When this happens, the private company becomes publicly listed through the shell corporation, and it and is at liberty to change the shell's company's name. Current shareholders in the private company will then exchange their shares to the shares of the public company to complete the takeover. Reverse takeover versus initial public offering.
So let's stop at that. Let's stop at that. So that we don't go deeper. The accounting is what I've explained. Okay. Okay, you can read more. I'll send you all of these links later. You can read more. Okay. Remember, this is a learning process. You need to do more of your research. This is not a theory or textbook, but you have to more or less get hold on it. Okay. Contingent liability, we've discussed that before, okay, which I've explained, okay, and we're going to look at illustration on it. Okay, let's wrap it up with these other three: spin-off, special purpose entity, and reverse spin-off. Can you read that for us and wrap it up from that?
Okay, sir. Spin-off. This entails the creation of an independent entity through the sale or distribution of new shares of an existing business or division of a parent company. This occurs occasionally when an entity disposes a whole or partly owned subsidiary or of an investee by transferring it unilaterally to the entity's shareholders. Special purpose entity, SPE, is an entity created to accomplish a narrow and well-defined objective, that is to lease research and development activities or a scrutinization of financial assets, which can be a corporation, trust, partnership, or unincorporated entity. Reverse spin-off. It entails a spin-off transaction in which the nominal or legal spin-off is to be accounted for as the spine in order to reflect the economic reality of the spin-off transaction.
Now let's look at, we've discussed this. Let's quickly look at the summary of this chapter. And this summary, we'll look at it and we'll wrap up. Okay. I want Mr. Nuruddin to take it up from here so that we can see whether all in all, we have been able to cover all of this before now and today. Summary of chapter 2.
Summary of chapter 2. 1. A group is considered to comprise of the parent and its subsidiaries. A parent is the business entity that controls the financial and operating policy of the other entity, i.e., the subsidiary. The subsidiary is seen as the business entity that is susceptible to the control of the parent entity. 2. Whenever a group exists, there is a responsibility saddled with the parent to prepare group accounts. 3. Group accounts are the accounts of the parent and its subsidiary, as if they are accounts of a single economic entity. 4. The starting point of preparing group accounts is the first date the parent obtains control of the subsidiary. 5. The parent ceases to prepare group accounts only when it no longer has control over the financial and operating policy of the subsidiary. Invariably, when control of the subsidiary is lost or deemed to be lost. 6. Acquisition date is the date of which Acquisition date is the date of which the acquirer obtains control of the acquiree. 7. Non-controlling interest represents the stake in the subsidiary other than that of the parents. 8. Control represents the power over the investee, the exposure or rights to variable returns from its involvement with the investee, and the ability to use its power over the investee to affect the amount of the investor's return. 9. Potential voting rights may be considered where it is likely other than not that it will be exercised in the immediate future period in assessing the existence of control in an acquisition. Acquisition-related costs are either expense in profit or loss if they do not relate to issues of shares or debt instruments. And where acquisition-related costs are attributable to issue of shares and or the issue of debt instruments, such costs are used to reduce the proceeds on equity instruments, debt instrument in accordance with the requirements of IAS 32 and IAS 39 stroke IFRS 9 respectively. 11. The acquisition method of accounting in a business combination may result in either a positive goodwill, i.e. partial or full goodwill, or negative goodwill, which results in a gain on bargain purchase. The allowance is provided for the acquirer in a business combination to adopt provisional values in the accounting for business combination within the first 12 months of acquisition, termed the measurement period, while subsequent adjustment within that period is permitted to restate the acquisition date accounting, which may affect goodwill or gain on bargain purchase. Where fair value is obtained after the elapse of the measurement period, i.e. grace period, the requirements of IAS 8 accounting policies, estimates, and error may apply. Provisional values are either the current amount or other equivalent measure other than the fair value, which is adopted as surrogate for the acquisition date fair value. Non-controlling interest can either be accounted for at proportionate share of the identifiable net assets of the subsidiary at acquisition date, or at the acquisition date fair value of the equity instruments of the subsidiary. Stroll up. Losses of the subsidiary can no longer be absorbed wholly by the acquirer or the parents, but such losses attributable to the non-controlling interest should be recognized in full, even when it results in a negative amount. Invariably, non-controlling interest can be negative and accounted for within equity. It is preferable that the parent and the subsidiary have the same accounting period, i.e. year end, to facilitate seamless process of consolidation. But situations are recognized that may warrant different reporting dates, but the consideration might be standard in such that the difference should not exceed 3 months. And material transaction within the 3 months should be adjusted for in the consolidation process. Where the difference in the reporting date is more than 3 months, a reconstruction of the accounts of the subsidiary to align with the reporting period of the parents will be necessary in order to conform to the requirements of IFRS 10. Before consolidation of the subsidiary accounts with that of the parent, efforts should be made to adjust the financial statements of the subsidiary to reflect the accounting policy of the parents, which invariably is the accounting policy of the group. The reverse acquisition may take place in a situation where the statutory acquirer, based on the legal structuring of the acquisition, later becomes the substantive acquiree, and the statutory acquiree now becomes the substantive acquirer. This is much more a strategy adopted by non-quoted companies to get listed status in the capital markets. There is an exemption to the principle of IS 37 on the recognition. There's an exemption to the principle of IS 37 on the recognition of contingent liabilities. Contingent liabilities are not to be accounted for. Rather, contingent liabilities are to be disclosed on the basis of materiality. The exception is the case. The exception is the case in a business combination, as IFRS 3 requires the recognition of contingent liability that arose from a present obligation and of which the fair value can be reasonably and reliably measured or ascertained as at the acquisition date. Invariably, such recognition and accounting for contingent liability upon business combination will have effect in the measurement of goodwill or gain on bargain purchase transactions. IFRS 10 contains special accounting requirements for investment entities. Where an entity meets the definition of an investment entity, see above, it does not consolidate its subsidiary or apply IFRS 3 business combinations when it obtains control of another entity. End of chapter 2 exercises. Does exist where one company considered the parent controls either directly or indirectly another company, the subsidiary.
Okay. You've read it, Nordin. What's the answer to that?
So that exists where the company considered the parent controls either directly or indirectly another company, the subsidiary.
Okay, if there's no idea, let's move on. Second question goes to Madam Grace. What constitute group accounts?
Group account is made up of the of the transaction of the subsidiary and the parent company in a consolidated financial report.
We'll consider that, looking at it, whether it's right or wrong.
Yeah,
and we'll see it later.
Number one.
Okay, that was number one.
Business combination.
I don't know whether it's right or wrong, but we'll just be moving on. 3, can a parent company with at least a subsidiary be exempted from preparing group account? If yes, kindly illustrate such instance or instances. Anayo. We can't hear you. You are muted.
Okay. I think yes, but I don't have an instance.
Okay. Let me give you this since you can't answer that. What basis provides a avenue for the exclusion of a subsidiary from consolidation in group account?
Okay, where the parent is also a subsidiary to another parent company.
Our internet is freeze. Okay, let's move on. Who will assist her there?
Okay, I would like to assist her.
You didn't hear me?
Okay. No, your network is bad. Don't worry. Okay, go ahead, check.
Okay, the basis for exclusion of subsidiary from consolidation is when the transaction of the subsidiary is immaterial.
Are you sure? Is that only exclusion? What is the primary basis of exclusion? We'll see that later. Okay. In addition to what you have said, what is non-controlling interest?
Non-controlling interest is any other interest in the subsidiary different from the parent or controlling interest.
Okay. Madam Oladokun, are there options to accounting for non-controlling interest upon business combination? Describe and which option is more preferable? Madam Oladokun, are you there?
Yes, I'm here. I'm not sure I know the answer to that.
Okay. Can I pass it on to my friend, Enao? Enao, can you unmute?
I'm commuting now. This is a little bit noisy.
Okay, no problem. We'll pass it on.
Can I talk about it?
Can you say something about it?
Okay, there are two options for non-controlling interest, either the proportionate share of net assets or the fair value methodology. But the fair value is much more preferable to the proportionate share of net assets.
Yeah, sure. Okay. And is it arguable that non-controlling interest cannot reflect a negative amount in the consolidated financial position?
I don't have answer.
Okay, you should have answer to this. How are the following acquisition-related costs in business combination treated? Issue of shares, raising of debt instrument, and those relating to legal, professional, valuation, and accounting services. How do we treat them?
Okay, there should be expense. The issue
All
of
of them.
shares, raising of
debt, all of them expense.
Yeah, I'm sure of A and C, but I'm not sure of that number B.
You are sure of
I'm
A,
sure.
but
Yes.
A is not sure of you. Okay, we'll know later. 9, Madam Grace, is it compulsory that accounting policy and reporting date of parent and subsidiary be the same? Elucidate. We can't hear you. You are muted.
Sorry, let me read the question again. Is it compulsory that the accounting policies and reporting date of the parents and the subsidiary be the same? The accounting policy has to be the same because the parent company, the policy of the parent company is assumed to be the policy for the subsidiary company. Then the accounting date, there are different instances. You know, like if there is difference between the the financial reporting date. If it's more than 3 months, they can consolidate it. But if it's within 3 months, they can consolidate. Or if it's more than 3 months, like 6 months, we prepare a reconstructed account to consolidate the financial statement.
But have we answered the question? The question says, is it compulsory? Is it a must?
Yeah, it's a must that the accounting policy of the parent company and the subsidiary company must, the parent company must give the accounting policy of the subsidiary company.
If you say it is a must, why are you now justifying exception? And when if they're not the same, you can go ahead. Okay, you are contradicting yourself. Don't worry, we'll look at it later. Okay. This is shown to the public. Anybody can answer it. Describe a reverse acquisition with practical scenario. Describe a reverse acquisition with practical scenario.
Okay, I want to try.
Okay, try.
Okay, reverse acquisition is when for instance, a limited liability company allows itself to be acquired by a struggling or small public company. And in such scenario, since the balance sheet capacity or the share value of the limited company is stronger and more than that of the public company, invariably the limited liability company has acquired the majority shares in that public company. So under the law, or looking at it from the legal perspective, it seems as if the public company is acquiring the limited liability company. But in the eyes of IFRS, following the doctrine of substance over form, the substance of the transaction is actually that the limited company has acquired the parent company. And in such instance, IFRS 10 requires that the limited liability company should prepare a consolidated account.
Okay, now let's look at the answer one by one. That exists when one company controls either directly or indirectly another company. Okay, my friend said business combination, but what the answer is parent-subsidiary relationship exists. Are you clear now, Nuruddin?
Yes.
Okay. Second question says, what constitutes group accounts? Madam said when we combine the transactions, okay, but I don't think it's right. Group account represents the account of parent and all of the subsidiary as if it is the account of a single economic entity. Okay, the next question reads thus. Can a parent company with at least a subsidiary be exempted from preparing group account? If yes, kindly illustrate such instance. What is such an instance? A parent company with at least a subsidiary can be exempted from preparing group account only when all of these conditions are met. Remember the 4 conditions. 1, you are a wholly owned subsidiary or you are a partly owned subsidiary of another entity in which you have had an agreement with the shareholders of those entities not to present group account, and that your instruments are not traded, whether by way of debt or equity, and you are not in the process of filing, or you are currently filing returns to the public authorities such as the Securities Exchange Commission for capital market purposes, and your ultimate entity or parent entity prepares consolidated accounts in accordance with IFRS. Okay, the next one is 4. What basis provide an avenue for exclusion of a subsidiary from consolidation? The only basis there is when control is lost before you even talk of materiality. A subsidiary can only be excluded from consolidation when control of the subsidiary is lost by the parent entity. It is secondary when you consider the issue of materiality, when the subsidiary is immaterial. Therefore, your focal point should be on control, not just on materiality. Okay. Number 5, question 5 says, what is non-controlling interest? I think that was well defined. Okay. Yeah, I consider it as interest in the net worth or net assets of subsidiary other than those of the parent entity. And the next question says, are there options to accounting for non-controlling interest upon business combination? Describe and which option is more preferable. It was answered, but there's no option that's more preferable in its real sense. You understand? It's a choice. Remember, I used the word jollof rice and fried rice as analogy. Which one is the best? What is best for you might not be best for me. You understand? It's an option available for us all. Okay, but we said IFRS 3 permit the adoption of either of the identified 2 options. The options are the fair value of the equity instrument and the proportionate share of the identifiable net assets of subsidiary at acquisition. The standard did not recommend an option, neither does the standard rank each option by order of prominence. Okay. 7. Is it arguable that non-controlling interest cannot reflect a negative amount in consolidated financial position? Okay. In that light, he said IFRS 3, okay, no, non-controlling interest can now be recognized as a negative equity value based on IFRS 10. This negative amount will still be reported within the equity, but as a deduction from the equity so attributed to the parent in order to obtain the total equity in the group. Okay, which is also a follow-up on our discussion today. 8 says, how are the following acquisition-related costs in business combination treated? Issue of shares, raising of debt instrument, and those relating to legal, professional, valuation, and accounting services. Now, we said it earlier that anything that is not attributable to issue of shares, not attributable to issue of debt instruments, will be considered administrative costs. And all of those administrative costs, which includes accounting services, legal professional valuation, etc., will be expensed. While issue of share, transaction cost, or issue cost will be charged against share premium or any other reserve or retained earnings as the case may be, which is a reduction of the proceeds of our equity. While issue of debt will be used to reduce the proceeds of raising debt, which we are going to discuss when we get to IFRS 9. Okay, question 9, which is the penultimate question, speaks to the fact that is it compulsory that the accounting policy and reporting date of the parent and subsidiary should be the same? It is not compulsory, even though it is necessary. What is seen is that it is not compulsory that the accounting policy and reporting date of parent and subsidiary should be the same, but it is preferable stance and recommendation of the standard. By and large, IFRS 10 clearly requires that upon preparation of consolidated financial statements, the accounting policy and reporting date of parent and subsidiary should be aligned, that is harmonized. Okay, and finally, I think the last question asks us about what is reverse acquisition. Okay, describe a reverse acquisition with practical scenario. And I think it's the same scenario we pointed out earlier that I've put up here. Okay, reverse acquisition addresses certain types of acquisition. And in such a case, what happens is where the legal acquirer becomes the substantive or accounting acquiree, while the legal acquiree becomes substantive or accounting acquirer. And this is a strategy that is used mostly by a big company to get listed or an unquoted company to get listed in the capital markets. That says it all. And if there's any other question, kindly put it up now. Otherwise, we call it a day or a long day. Any other question, clarification?
It's not a question, but clarification, sir.
Yes.
And my clarification will goes to question 6, where it talks about the methods of value non-controlling interests. I remember that the last time we discussed this, I raised a query that when we read a write-up where we got to a point where IFRS said fair value measurement is preferable. That's what made me raise an eyebrow that, okay, when IFRS say a particular standard is preferable, why are we bothering ourselves to measure using equity, what do we call it? Proportionate shares of net assets. But with the response today, I think you are trying to say there is no preferred method for either both of the two can be adopted. But I think with what we read the last time, there was a clause that said IFRS preferred fair value measurements. Thank you.
Okay, you can search further. Okay, the question is so straightforward, which says, describe and which method is much preferable. To who are you describing much preferable? Do you get what I'm saying now?
Yes.
The question is, if it's more preferable, there won't be options. Do you get what I'm saying now? Am I making sense? Okay.
Yes. I think there may be options even when a particular method is preferable. But
remember that IFRS is not rule-based. IFRS is principle-based. That's why they put all options on the table on the same scale.
Noted.
Okay. Any other question? Okay, in the absence of no question, thank you. I should call it a day. Goodbye.